We've got a good situation here. Things are indeed getting better.
You're still seeing that some of that U.S. exceptionalism is still there.
While we look at the earnings data that is in front of us, that looks to be quite positive, as we look ahead at the second part of the year, we're not quite as optimistic.
I wouldn't mind if things just kind of simmer down a little bit. And I think they will.
You've got all these disconnects that I think markets have to reconcile themselves with.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, let's get your week started. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Berro, coming off the back of the biggest weekly gain of the year so far on the S&P 500, leaving behind the growth scare of just 2 weeks ago and taking some comfort from better retail sales, softer inflation, contained jobless claims. The week ahead, well, let's get to the week ahead in just a moment. Let's start with equity futures on the S&P 500. We're doing okay, totally unchanged, coming off the back of a 7-day winning streak. On the Nasdaq 100, just a little bit softer. We're down 0.1%, and the small caps going absolutely nowhere. Lisa, the week ahead absolutely stacked. But let's talk about the main event. It's Friday, Jackson Hole, Wyoming. You'll be there. Chairman Powell addressing the nation, addressing the world.
At 10 a.m. And the key question for him is, can he be dovish enough, given the fact that this market is set up for basically the soft landing nirvana that we saw earlier this year? Essentially, the economy is doing fine and the Fed will still cut rates by potentially 100 basis points by year end. Can Jay Powell come out, confirm that, and give justification without a significant weakening in the economy?
Hard landing to soft landing. You wonder whether we can flip back again. Let's hit the calendar. September 6th is payrolls. September 11th is CPI. September 18th is that Fed decision. Can this story change all over again in the next month or so?
It could change in the next 2 days, John. This is basically the story we've been living is, narrative table tennis or ping pong has been absolutely on fire over the past couple of weeks. Whipsaw central, just this feeling that anything could change, given the fact, just this is a good example, Goldman Sachs' Jan Hatzius just a couple weeks ago came out and said, we're actually increasing our recession forecast to 20 to 25% because we're very concerned about what we just saw in the payrolls print. Now they downgraded the recession forecast over the weekend, basically saying, just kidding, we saw those retail sales and we're right back almost to where we were before.
Back and forth over the last 18 months or so. It's been one narrative to the next. At the DNC was supposed to be Anne-Marie, and she's with us around the table with a report on air traffic control in the New York area. What is your report on air traffic control?
Well, all flights are grounded until this morning, and it's very hard and difficult to get on a flight that's going to leave the New York area today, Jonathan.
They'll have some things to say about airlines and price caps and price gouging and those kind of things. Do you want to talk about that? Have we actually got the policy yet? Do we know what the policy actually is?
Well, it's very thin on details, but there's been a huge amount of pushback from economists. Look at Ken Rogoff over the weekend saying there was some mixed ideas in here. This one was certainly a bad one, and they should abort this. What we heard from Kamala Harris on Friday, Jonathan, when it comes to price gouging was the fact that she said she wants to basically encourage Congress to expand the FTC ban on price gouging when it comes to grocers. It's illegal in most states, so they're talking about now just making this federal. This has got a tremendous amount of pushback because it is thin on the details. And many people said, well, this sounds like price controls. Washington Post editorial board says this sounds like a gimmick. You've seen a lot of people push back and say, no, she's for free markets. This is not what they want to do. The issue, of course, Lisa, it's politics. It polls well.
Well, this is the reason why I find this incredibly frustrating. And I'm going to be on a, absolute broken record at this point. But it's frustrating because you don't know what to take seriously and what to take as some sort of bid to get voters. And so at what point, this is the same thing that we see with Donald Trump and we see with Kamala Harris. At what point do you take them seriously, but not literally, right? Is this sort of a signal, whistling to certain groups rather than actually coming through with policy? We don't know the answer, and I think that that's one key question.
You'll love this headline from The Atlantic, economically dumb, politically smart. Isn't that the kind of thing that drives you insane? Economically dumb, politically smart. Before we even critique the policy, go through what the policy might even look like, we need to talk about whether there's even a problem. If you look at grocery retail margins, they range from anywhere between 1% to 3%. If you look at food inflation in a CPI report from last week, what were we running at? 1% year over year? Is this even a problem that needs addressing? Isn't this the war of 2 years ago?
Especially at a time where you have Kroger set to slash their costs for consumers by some $1 billion with the Albertsons tie-up. Look, you are correct. This raises a question of whether this is economically sound or whether it matters, and at what point this means that we're actually going to hear real tangible policy, or whether it's all going to be just like messaging in a way that doesn't give people a concrete sense of what the actual platform is. That, I think, is one of the key questions from people who actually care about policy.
Well, it was just a few months ago when this White House was welcoming those cuts we talked about at Walmart, at Target, at Amazon, when they were slashing prices, saying, finally, corporations are listening to us. But this goes back to a report the FTC put out in March, that they said some companies were basically using the pandemic era to inflate prices higher than they thought was acceptable. So they're leaning into that frustration because you know why? Kamala Harris is the incumbent right now on this ticket. And if the number one issue across voters is the economy, notably inflation, she needs someone else to blame besides Biden-Harris.
If we had a more focused Trump campaign, what we would have repeatedly day after day, and he did mention this briefly over the weekend, if these are things you could have done, why didn't you do them? You've been there for the last 3.5 years. I think on this programme, we've described the Democratic ticket repeatedly over the last month or so. If it were a stock, it would be facing a relief rally. Just because we've seen the back of the other guy. It's the CEO no one wanted there at the top of the company. New CEO comes in. We're sitting here waiting for the policies and the vision of the new CEO. We've got this honeymoon period. The CEO comes out and does a news conference and kind of mentions a little thing here and there. The analysts come out and say, what on earth is this about? Then they back away from it again. And we still don't really have a policy platform going into the DNC. Now, this is a double-edged sword because both the beauty and the beast of the Harris ticket is it can be anything you want it to be. And that's been the beauty of it over the last month or so. It's going to become more and more of a problem over the next couple of months.
When? And this is the key question. When is it going to be a problem? Is it going to be the debates with Donald Trump? Is he going to be able to hold her feet to the fire? Exactly to your point. Is it going to be pushback within the own party in terms of the DNC when it comes to protests? Is it going to be actually when people ask and have Kamala Harris sit down with a television newscaster and have an interview?
Actual questions.
Actual questions. At what point? Because right now, as you pointed out, Donald Trump's camp isn't doing it. In fact, he's actually facing pushback from the sort of MAGA camp saying that you're not extreme enough to the right. So, you know, at what point is she going to get a free pass just because the pressure isn't there from the other side?
We'll keep navigating, or at least attempting to navigate, the mess in front of us over the next couple of months or so. Your scores look like this. Welcome to the programme. Equity futures on the S&P just about positive, coming off the back of a 7-day winning streak on the S&P 500. In the bond market, pulling back a single basis point on a 10-year. Your yield on a 10-year maturity this morning, 387.11. That's the market backdrop, Bramo. The week is not just about Jackson Hole. We've also got some earnings on Wednesday as well. Absolutely stacked.
Yeah, Target earnings coming out on Wednesday. We also have Biden, of course, speaking at the DNC today. It's supposed to be sort of the first in his goodbye speeches. Kamala Harris will be speaking on Thursday. And, of course, Powell speaking on Friday at the theme. And I want to just note this. The theme is reassessing the effectiveness and transmission of monetary policy. I want to hear what they have to say about how effective it has been at bringing down inflation. There's one other event that sort of seems like a side note, sort of akin to auctions, but that I actually think is very important. And that's going to be what we see with preliminary revisions to payrolls on Wednesday, when the BLS, the Bureau of Labor Statistics, goes back and actually will downgrade how many jobs was added to the economy. That's the expectation. Does this raise questions about just the resilience of the U.S. economy?
That data you all traded on over the last couple of years might look a little different. It's kind of odd, isn't it?
Completely.
Yeah, we'll get into that a little bit later. That's the lineup for the week ahead. Here's the lineup for the next 60 minutes or so. We'll catch up with Lori Calvasina of RBC with stocks close to all-time highs. Nela Richardson of ADP looking ahead to Jackson Hole. And Steve Englander of Standard Chartered with the dollar on a 4-week losing streak. We begin with our top story. The S&P 500 coming off its best week of the year as we await Fed Chair Jay Powell's remarks at Jackson Hole later this week. Lori Calvasina of RBC writing this: we're on guard for choppy conditions to persist for a while longer. And don't rule out a growth scare if economic data releases continue to disappoint. For now, our 5,700 year-end price target still stands. Laurie's with us in a room around a table. Laurie, good morning to you.
Good morning.
Proceed cautiously is some of the advice you're giving people at the moment. Why is that?
So look, I would say we put an equal emphasis on the proceed and the caution, right? And, we do think that it's, we've had sort of the worst behind us, right? We think we saw the lows on August 5th. But, I was looking at the retail sales data last week, right? And it's kind of chopped around the last, couple of reports, right? And so we're coming off a good one, right, where it's relieved some angst. I am cognizant as someone who's been on the sell side for more than 2 decades. We're going to come back after Labor Day, and we're going to be just absolutely deluged with sell side conferences, right? We're going to be hearing all kinds of stuff from companies And so I think it's going to give investors another chance to sort of dig into what happened this summer, what's going on with the consumer. You know, even if we kind of put the consumer aside, one thing we keep reading from companies who work with other corporations is that all of the uncertainty from whether it's interest rates, the election, geopolitics has been weighing on business decisions. You know, we heard this from actually one of the industrial companies last week. And so I think we're kind of going into this period, right, where we're pretty fully valued. You know, some of my models say we could go to 5,800, but my valuation model says kind of 56-ish, 5,600-ish is about fair value if you get 3 or 4 Fed cuts this year. So we've got, you know, pretty fair, full valuations, and we could be going into a period, right, where we're hanging on to every little economic data point again.
We're doing that already. I think the big difficulty we're having, particularly over the last year or so, the contradictions between what we hear from the companies and what we see in the economic data.
Yeah.
I'm sure the team were talking about this with regards to retail sales just last week. Retail sales, the data looks pretty decent. What we hear from the companies, very different story. So you've got to make a decision on a sales side. How much weight do you put on one versus, say, the other? Do you put more weight on the data or what you're hearing from the companies?
So I would say on data, I tend to put more weight on hard data as opposed to survey data. I think some of the survey-based data, like the ISM reports, for example, you know, do a better job of spooking investors, especially on the manufacturing side. But I'll tell you, John, I do read through a lot of company transcripts, and we pay a lot of attention to what they're saying about consumers in particular. And I do think that what we've seen, you know, this reporting season, maybe the tail end of the last reporting season, is yes, there's been a step up in concern about the consumer. Consumers are clearly reacting in a more profound way to the cumulative impact of inflation. So prices are still high, even though the pace is decelerating a bit, and also of interest rate uncertainty. But at the same time, you know, we saw one company write last week saying we're not seeing further fraying happening, right? So it's kind of a very balanced, nuanced discussion where I think companies are saying, yes, we're seeing an impact, but we're not alarmed in that we think consumers are really breaking down in a profound way.
That company was Walmart, and that company reported incredible earnings, and that company talked about the potential for sales to increase and margins to increase, which is something that we have seen pretty consistently across the board. Margins are increasing. Does that speak of layoffs to you in the future?
So we've looked at what companies are saying regarding cost consciousness of their own, restructuring, layoffs in particular. We're not finding much. In general, the layoff conversation, I think it peaked in 2021, and it's been coming down pretty markedly. Overall, what we're seeing is companies are really still focused on things like automation, software tools, kind of this technological revolution. All these tools that have come out since, you know, kind of the 2016 period, they allow companies to attack things other than labor first when they need to defend their margins, to defend their earnings. And they still seem to be, you know, somehow getting water out of this rock. I don't know if it's going to last indefinitely, but I've been thinking this for like 3 years, that we're going to suddenly have a reporting season where this doesn't work anymore. And they seem to really just be good at getting it done. Smaller firms, not as much. I think that's been one of the problems with Russell 2000 is their earnings and their margins just can't keep up because, in fact, they don't have the same kind of scale. They don't have all the same kind of tools.
I love the idea of water from a rock, and it sort of indicates this sort of biblical back and forth that people are talking about. How much is the rally continued to be hinged on what happens with Jay Powell on Friday, whether he comes out and gives a nod to all of these expectations for some sort of rate-cutting cycle that can match what the market is expecting?
So look, you know, I at least in my conversations, right, and I deal more with equity clients. I deal with a lot of long-only clients for the most part, so I can't speak so much for kind of the fixed-end hedge fund side of the world. But in my mind, you know, I've even had, you know, if I think back a couple months ago, some investors were saying we don't think we need cuts this year because the economy is so strong. And I certainly haven't been hearing a lot about 50 basis points. I do think people want the Fed to cut. I don't necessarily know in my world that 50 is demanded, but you know, there's certainly some corners of the market that want that. So could there be some potential disappointment if you don't come away with messaging supporting that? Of course. I would view that as more kind of short-term dislocations, noise, as opposed to anything fundamental. I think in my world, people want the cuts to get started, and that's about it.
Let's pick a sector, financials. You're starting to like the financials. Do the financials demand a 50 basis point cut? They need one?
I think financials, you know, would like enough cuts to keep the economic expansion going. I think that financials would probably not handle it all that well if we have so many cuts that we start to spook people about the health of the economy. I mean, the financials trade very closely if you look at relative performance with consumer confidence. And they also really have become, it's kind of a boring sector, frankly, but it's really just sort of the plumbing of the economy, right? Like it's just sort of the guts of things. So I think they'll react to that as much as cuts, but I think financials would do well with a cut, some cuts before the end of the year. I think they want to get started in September, but I don't know that you need the sort of panicked cuts.
It certainly feels like we're in a calmer state of things, Lisa, after the data we got last week. I don't know if you saw the interview with the San Francisco Fed President Mary Daly in the Financial Times. There was a key phrase in that. The economy is not in an urgent place. A much calmer state after the data of last week going into Jackson Hole, and maybe that benefits the financials.
She was arguing about gradualism, not being weak, but being prudent at a time where the economy is certainly not falling off a cliff. Now, I'm wondering, as I was reading that interview, does this actually support what the market is really hoping for and seeing? Because it seems like we're back to the future. We're back to where we were in January, where the economy isn't falling off a cliff, but because inflation's coming down, because of all these other types of factors that we heard from Austin Goolsbee over the weekend as well, the Fed can still cut aggressively. If they don't come through with this, then we go to their theme. The transmission mechanism, is it failing on both sides, right? How much are they actually going to effectuate anything other than a massive rally in risk assets one way or another, or decline in risk assets as they decide to move their policy?
Do you think these are the right kind of rate cuts? Are these the right kind of rate cuts that you're anticipating?
I think so. I think at this point, inflation has come down. We're not to the 2% target yet, but, to be honest, a lot of my conversations, people don't think that's realistic anymore. So, I think that you have seen the Fed start to talk about both sides of the mandate. The inflation genie, I would say, has not been completely slayed. We do know if we look back at history, it is tough, right, to get inflation back in the bottle once it comes out. And I think the Fed pays some heed to that. But at the same time, we're hearing a lot of chatter about the employment side of things. I think they want to stick the landing. I do take them at their word when they say they're data dependent. And so as much as we would all like to have these crystal balls that we can see out for the next 6 to 9 months, that may just be something that's not realistic in this scenario. We may have to let them be, data dependent meeting to meeting.
Laurie Calvasina of RBC. Laurie, you're going to be sticking with us. Equities right now on the S&P 500, just about unchanged. Let's take the opportunity, just a little bit of time to get you an update on news elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Circle K operator Ghosh is looking to take over 7-Eleven owner 7&I Holdings. It would be the biggest foreign takeover of a Japanese company. Together, it would create the world's top operator of about 100,000 convenience stores. 7&I says that the bid is preliminary and non-binding, and terms have not yet been disclosed. Donald Trump is battling Kamala Harris for momentum this week. He is planning an aggressive schedule as the DNC kicks off in Chicago. He's going to hold rallies in 4 swing states and visit the U.S.-Mexico border on Thursday. That's ahead of Harris's acceptance speech at the DNC. He'll also sit down for a series of interviews. His aides say that it's specifically an intentional effort to try to goad Harris into an unscripted interview herself. A Washington Post and ABC News poll released Sunday shows that Trump lags Harris by 4 points. Israel and Hamas leaders are blaming each other for a stalled ceasefire and hostage deal. Israeli Prime Minister Benjamin Netanyahu accused Hamas of completely obstinate, while Hamas said Netanyahu is fully responsible. U.S. Secretary of State Anthony Blinken is now in Israel, now meeting with top leaders. Earlier today, he said that this is a decisive moment and maybe the last opportunity. The U.S. said talks on a Gaza ceasefire are in the final stages. And that's your Bloomberg brief. John.
Danny, thanks for that. Appreciate it. The President's National Security Advisor, Amos Hochstein, coming up a little bit later on the programme. A few hours from now, Amos Hochstein joining us a little bit later. Don't miss that conversation. Up next on the programme, the Harris economic pitch.
When I was Attorney General, I went after price-fixing schemes. And when I am President, I will continue that work to bring down prices.
80 days from now, we are going to defeat a communist known as Kamala Harris.
That conversation up next, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Your scores look like this on the S&P 500, just about positive this morning to unchanged on the S&P 500 in the last 20 minutes or so. Under surveillance this morning, the Harris economic pitch.
When I was Attorney General, I went after price-fixing schemes. And when I am President, I will continue that work to bring down prices. I will take on big corporations that engage in illegal price gouging.
80 days from now, we are going to defeat a communist known as Kamala Harris. She's a communist. Most radical left person ever to run for office. This is not what this country needs.
So here's the latest. Kamala Harris riding a wave of momentum as the DNC gets underway in Chicago. The vice president holding a 4-point advantage over Donald Trump in the latest polling from the Washington Post and ABC News. Harris set to address the DNC on Thursday following comments from VP pick Tim Walz on Wednesday and Anne-Marie President Biden later on tonight.
Tonight's going to be the passing of the torch. President Biden is going to come in. There's going to be a lot of love for him in the room for the fact that he basically, for the Democrats, how they view it, saved the country from Donald Trump, and now he was able to pass the torch to the next generation. It was literally Sunday 4 weeks ago when he dropped out. And when you look at the polls over the weekend, this is an absolute change in this election. The way Kamala Harris is able to narrow the gap between her and the former president. Actually, she's leading when you look at the head-to-head matchups.
Lori Calvasina of RBC still with us. Lori, is there anything to analyse here?
From my seat, not so much. I mean, we put a piece out this morning in our weekly, and we just commented on there being some headline risk, right, for things like healthcare and consumer staples. It's not a lot I can analyze at this point in time. I mean, we have at least something, and that is positive, right? Because I've spent, honestly, the last year talking with non-U.S. investors about this election and having literally nothing to analyze from the Biden administration. So at least I have something to talk about at this point in time. I have, a sense of sort of gut instincts. And so that is huge. As a forecaster, I have something to look at, but it's not a lot.
What's your gut instincts on price gouging? Pure rhetoric?
So, I read a lot of transcripts, right? And we've read a lot of consumer staples transcripts. I'm not so much thinking about this reporting season. I'm thinking most about the last reporting season. And it did seem to me like some of the consumer staple companies were a bit tone deaf, in terms of talking about passing price increases through at a time when they were also acknowledging low-end consumers in particular, kind of pushing back. And so I kind of understand it from that perspective of just the messaging that I've seen on some of these earnings calls. But at the same time, I don't think this is going to play well in economic circles.
You're one of the few 2 weeks ago when the markets were imploding that said part of this is the Trump trade unwinding.
Yeah.
Do you see the Trump trade coming back in? And also, what is the Kamala Harris trade?
So I don't know if we totally know what the Kamala Harris trade is yet at this point in time, but one of the things we said with the Trump trade, people were talking about financials and energy and the 2016 playbook, and we said, look, if we just look at how markets are trading in terms of what's really moving with Trump, and we looked at betting markets specifically, it was really just the S&P, right? It had a positive correlation whether you looked at predicted or whether you looked at some of the betting market averages, and if you looked at U.S. relative to Europe, that was also pretty correlated with Trump. So we've been watching that in recent weeks, right? Because we've had the market rebounding, you've had Harris pulling ahead in the polls, you've had the betting market starting to shift as well. We did notice when we did our Friday updates that you had seen an uptick for Trump in the predicted market. I'm not sure if that held over the weekend. I haven't looked at it. But we looked at that and we were, sort of prepared to write, well, maybe this is starting to break down. We said, maybe this is sticking around. Maybe this is still somewhat aligned.
No one campaigning on getting tough on the nation's debt. You noticed that?
I don't think there's appetite. I mean, look, I'm in armchair political scientist mode here, but so forgive me. But
we're both in the same seat.
Yeah,
don't worry.
But when I get asked about this all the time in client meetings, and the thing I say is, look, if you look at sort of both sides, there doesn't seem to be any appetite for fiscal restraint. And I go back to kind of my Politics 101 class at UVA, where Larry Sabato reminded me that all politics are local. And, we talked a lot about bringing home the bacon and that kind of thing. But at the end of the day, remember, Congress is trying to get money to their districts. And we saw, some news headlines recently, right, about the IRA money and some of the tax credits and some of the Republican congressmen saying, please don't take these away. I think that just sort of illustrates the point, right? Like, what's the incentive of the individual lawmakers to be fiscally responsible? I don't think you get there until there's some sort of big crisis looming.
I asked that question just for Bramo.
Thank you. I appreciate
Anytime.
that. Just want to point out that there's a $16 billion 20-year auction coming on
30
Wednesday.
year as well later this
Yeah,
week.
so to me, I'm looking at this and thinking, is it going to matter? Are we making auctions great again? I just want to keep putting that out there because this is going to be the main question for a lot of people in terms of volatility hinging on this election.
Is it fair to
season.
say that both candidates are looking to make auctions great again?
Yeah, and actually, I have some studies that I've been reading about both of them, and, we can go through some of that later.
Looking forward to it. We'll do that in just a moment. Laurie, it's good to see you. Thank you.
Thanks for having me.
Thank you very much. Laurie Calvasina of RBC. Coming up next on the programme, we'll catch up with Nela Richardson of ADP, head of Jackson Hole, a little bit later this week. From New York City, this is Bloomberg. 7-day winning streak on the S&P 500. Let's see if we can make it day 8. Equity futures right now on the S&P totally unchanged. Looking over the last 7 days or so, a rally of close to 7%, up by 6.8% over that period. The best run going back to something like 2022. Lisa, it's been quite a run and a very different story to how we started this month.
Can I just point out that when I went on vacation, the market went to, hell in a handbasket. When you went on vacation, it rallied the most of this year. Just want to point that out. I mean, there's no correlation necessarily.
What are we suggesting, that I should go on vacation more?
I don't know. I'm just pointing out that, this is what happens. So people might call me gloomy and doomy, but last week I had returned from vacation and it happened to be like the biggest rally of the year.
Is that because you're happier when things are lower in the market? Is that what that's about?
I haven't worked through it, but I just wanted to point that out.
She's upset she missed that rough bond
That's what this
auction.
is about.
Yes.
Right, okay. You wanted to be here when markets were like cratering.
I'm not saying anything. I think it's important to really focus on the debt auctions.
AMH is aggressively nodding her head to that assessment. Let's turn to this bond market. Lisa can really get knee deep into this, sort of up to her neck in it. On a 2-year right now. Incidentally, when I left 2 Fridays ago, the 2-year was just about 4.05%, and that's exactly where the 2-year is right now, at 4.05%. There was all this fear that we were going into this hard landing, really ignited by what we saw in the labour data to start the month of August. And Lisa, things have calmed down a heck of a lot since then, encouraged by what we saw in retail sales. And since then, over the last few weeks, jobless claims have just pulled back just a touch as well over the last couple of weeks. And I think that's restoring some confidence going into Jackson Hole.
This is what I find fascinating. That basically this is back to the beginning of the year, where essentially you could have a good economy and you could have aggressive rate cuts, because guess what? You could have the immaculate disinflation. We're breaking that back again in a massive form. And we're expecting Jay Powell to really lean into that on Friday, saying that essentially to normalize policy, you have to bring rates down pretty consistently. And we heard that from Austin Goolsbee. We heard that from Neil Kashkari over the past few days. So to me, that's what's interesting about the fact that the bond market looks like it's been somnolent since you've been gone, whereas stocks have been whoop, 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 because they're really responding to the soft landing, hard landing kind of whipsaw.
I want you to do that again. What have stocks been doing?
Whoop, whoop, whoop,
okay,
whoop.
Thanks for that, Bramo. I've missed you.
I missed you too.
Okay, that's stocks and bonds. Let's get to foreign exchange and a different central bank, the BOJ. I want to talk about dollar yen. This is good news. The fact that this is what dollar yen is doing, and the equity market's just about unchanged on the S&P. So this is a lot of Japanese yen strength. Dollar yen down to about 146.48. If this was 2 weeks ago and we had a move like this on dollar yen, Lisa, I think we'd have a very different picture in the stock market.
Yeah, people right now are looking to some sort of explanation from Japanese authorities of why they hiked and what they have going forward. But you're right. How much does this really show how much we've unwound the carry trade? We're not as vulnerable as we used to be. Hedge funds are actually going long the yen. So this isn't disruptive in the same kind of way as it was in the past. It kind of raises this question, how much was last week the healthy washout that allows the market to really rally that much further, because there aren't necessarily the excesses baked in?
Just a pure observation this morning, clearly breaking that connection between what's happening in the Japanese yen, the FX space, and what isn't happening in the equity market this morning. Under surveillance this morning, the race for the White House hitting fever pitch this week. Kamala Harris set to speak at the DNC on Thursday. Before that, we'll hear from President Biden tonight, and VP Piegza was on Wednesday. Donald Trump countering the event with rallies in 4 swing states, a trip to the US-Mexico border, and Anne-Marie, a series of interviews.
He's really going to try to paint this split screen this week as you see this momentum building and coalescing around Kamala Harris at the DNC, when she'll pretty much be anointed leader of the party right now. The issue Trump is having, and this was all across the Sunday shows yesterday from a number of individuals, whether it was Nikki Haley last week or Senator Graham yesterday, Governor Sununu yesterday, saying almost any other Republican candidate would be winning the race by 10 points if you talk about these economic issues. What the campaign is trying to do, what Republicans are trying to do, is get Trump to stay on message. Can he do that this week? That's a big question.
You started by talking about how Kamala Harris is basically riding this incredible wave of, goodwill and a feeling of just, at least you're not the other guy. Is she going to be challenged? I think is the bigger question right now, because who is going to do it? Is it going to be Donald Trump? Is it going to be her own party? Is that pressure even on when we're not talking about real policies? Lori Calvasina is talking about how all the policies are just being taken as sort of noise to cater to certain constituencies rather than actual policies.
The rhetoric of the policies is to try to paint a picture of positivity, momentum. We're happy warriors. This is going to be a joyous convention. One thing we need to watch out for, though, as the Democrats try to paint this picture of unity, there are going to be potentially mass protests at the DNC for the Biden-Harris administration's handling of the Gaza war. You see the president really leaning into this. He wants to try to get a ceasefire negotiation. Antony Blinken will be meeting with Netanyahu today. They want to shore this up before November 5th.
Steve Eisman came on this program a number of months ago. He said that the former president would win this election race. I think at the time Joe Biden was still in the race. And he said that was the reason why, that when people started to see that, the images that came from the DNC, the tide would turn the other way.
Right. They would be reminiscent of 1968 when you had these protests at the DNC in Chicago. That did not go well that year for that election when it came to the Democrats. So potentially this could take some of the shine off of that momentum they have. But the momentum, if you look at the polls over the weekend, clearly on their side, which is why the Republicans want Trump to remain on message. Because you look under the hood of the polls, even the FT poll last week that said more individuals now see Kamala Harris, that they trust her on the economy. Under the hood, when you ask people if they feel better, inflation, the trust remains with the Trump administration when it comes to the top two issues, the economy and immigration.
He is struggling to remain disciplined. Let's put it that way when it comes to campaigning. This week is stacked. I mentioned that a little bit earlier. We also get some earnings from some retail-facing companies, some consumer-facing companies, Macy's, Target, TJ Maxx, among the names reporting on Wednesday. Those names report following a decent read on retail sales last week. And Lisa, we talked about some of the contradictions between what we're hearing from some companies on the consumer in America and what we're actually seeing in the hard data in retail sales.
The hard data also being Walmart, which doesn't see any fraying of the consumer whatsoever. Key question to me this week will be how much is this the big are getting big? The big are getting bigger, I should say, and Walmart gaining share at the expense of, say, Target versus rising tide lifts all boats. This isn't the same kind of strong consumer that can lift everybody. And I think that that's really maybe what we're going to see in some of the earnings this week.
Look out for those numbers on Wednesday. The main event, of course, on Friday, when Fed Chair Jay Powell delivers remarks at Jackson Hole. Traders looking for fresh insight into the Fed's path forward as the rate cut debate shifts from how soon to how much. Joining us now around the table is Nela Richardson of ADP. Nela, good morning. It's good to see you.
Good morning. Great to be here.
I want to go back to something you were talking about a few weeks ago before we get into Jackson Hole and what we could expect to hear from Chairman Powell. You said it's too early to talk about a hard landing when others were talking about a hard landing. You said the middle part is difficult to read. Can you walk us through all of that again? Because I think the data over the last week or so validates your approach.
Well, this would be a very different Jackson Hole conversation if the data didn't break out the way it did last week. What we saw is there's still strength in this economy. You saw it with the consumer, you saw it with the job market, and you saw that inflation was going down. And so, yes, it was way too soon to talk about recession or a hard landing. And I think the goal, to me, for this Jackson Hole conversation is to put the brakes on the fear-mongering about the recession and tell us what normal looks like. We, as an economy, either Main Street or Wall Street, we don't have a good view of what a normal economy looks like. Not in the unemployment rate and not in the inflation rate. Remember, we're coming from a period where inflation was too low before the pandemic, not too high, and where unemployment was below 4% comfortably. We're not in that regime anymore, so what does normal look like?
Can we tease out your assessment of that? What do you think normal looks like? What would you say if you were Chairman Powell this Friday?
Well, first, I would make it clear that we are not going to do an emergency rate cut for something under 5% unemployment rate. That was ridiculous. I would shape that narrative of what is the natural rate of unemployment for the economy. The second thing I would do is talk about this framework. Now, I know this is a conversation that the Fed will actually have next year, but we left the pre-pandemic period with a Fed who said that they were comfortable with inflation peaking above maybe up to 2.5%, that we would average that 2% target. Well, we're not in that regime anymore. So what is the comfort zone around the target that the Fed was willing to promote? It may not come in this conversation this week, but it will certainly come at the end of this year and into 2025.
Nela, you said that the idea of an emergency rate cut is ridiculous, and that if you were here
for under 5%,
for under 5% unemployment. Sorry, I didn't mean to misspeak. That was where you thought he should start. And that's why I think it's so fascinating that the theme of this Jackson Hole is reassessing the effectiveness and transmission of monetary policy, because it comes through them flapping their gums. I mean, basically, this is the main aspect of monetary policy that we hear on a regular basis is forward guidance. At what point does the forward guidance have to dampen the sort of Goldilocks, immaculate disinflation that's being celebrated right now in markets?
I think what you hear in the Jackson Hole arena is much more a more contemplative Fed. Right? And the limits of monetary policy. And where do you see those limits peak out? The housing market. There's only so much the Fed can do. It doesn't matter if you raise rates up or down by 50 basis points. You're still going to have this Iceland in the housing market because there's not enough inventory. There are other places where the Fed's reach is not as effective as even it was in 20, 30 years ago. So there is a humility about the transmission mechanism that you'll see this week that is not part of everyday conversation.
If that's the case, what difference will it make if they drop rates, if they drop borrowing costs significantly or not in the near future, especially if that's already being priced into financial markets?
You're already contemplating my answer to that. There's not going to be I think those who are thinking that this rate cut is going to change Main Street are overestimating the power of 50 basis points on the street. Not the Wall Street, the Main Street. It's not going to make that small business hire 5 more people. It's not going to change the calculus of someone who's living paycheck to paycheck. It'll matter for people who are about to buy big purchases like housing, like they're leasing their car payment, but will it matter for the rank and file of Main Street, for Main Street consumers? Not as much as it will matter on Wall Street.
So this is really the key question. Will essentially rate cuts bolster asset prices with little other effect in the broader economy?
In the short term, yes. In the long term, what it does is it leads to this normalization of the U.S. economy, where we started with the first question of this conversation. What is the natural rate of unemployment? Is inflation going to go back to sleep like it did the 20 years preceding the pandemic? I think not. I don't think those disinflationary forces are the same or as effective as they were before the pandemic, those being demographics and globalization. So if the Fed is confronted, if central banks around the world, which is the focus of Jackson Hole, not just the U.S., but global central banks, are confronted with periodic bouts of inflation now, that they didn't have to confront before the pandemic, then that changes their game. It changes how they view inflation, and it changes the actions they take now because they set a precedent for the future.
Nela, I want to talk a little bit more about the housing market. Last week, the data was really soft when you look at new housing starts and the confidence when it comes to builders. Even Home Depot was saying they're seeing it with consumers deferring projects. Kamala Harris has this proposal for $25,000 for new home owners. Potentially, she wants to do this if she's elected and she gets the Congress with her. Doesn't that increase demand? And then wouldn't it raise prices? How do you view that in terms of an economic lens?
It's interesting to me that housing is not more of a voting issue. Many Americans pay more than 30 to 40% of their budgets on housing. And prior to the financial crisis, every administration, Republican or Democrat, had a national housing plan that evaporated after the financial crisis. So just sticking your toe in these waters that affect so many Americans, either candidate may get some breathing room in terms of that consumer, that worker who really does, where housing really does make a difference. Now, is this plan, does it go far enough? I don't know. I think that the conversation on housing is really important, though.
Nela, appreciate your input. As always, you're going to Jackson Hole, right?
Yes.
I think you're going to catch up with the team as well when you're over there, so looking forward to it. Nela Richardson there of ADP and a Bloomberg TV contributor. There are still some banks looking for a 50 basis point cut at the next meeting. One of those banks is Andrew Honhorst over at Citigroup, and he mentions housing, which Anne-Marie just brought up. Lisa, he said the continued contraction in manufacturing, falling housing starts, the rise in the unemployment rate are telltale signs that the economy is poised to tip into recession. That's the view from Citi. They're still looking for 50.
He's been talking about, Andrew Honhorst, a downturn in the economy that's more pronounced. Key question, this really goes back to the theme of Jackson Hole. How much can a 50 basis point rate cut really ameliorate the situation in housing? And how much is housing kind of divorced from some of the other fundamentals of the U.S. economy? Real deep questions that actually I'm excited for the philosophical debates on Friday.
Coming up, Tom Keene, Lisa Abramowitz on Friday talking about housing and philosophy. philosophical debates about housing. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Ernesto has re-strengthened into a Category 1 hurricane. The storm is now passing near Canada, impacting the U.S. East Coast and the Canadian Atlantic coast. The National Hurricane Center said life-threatening surf and rip current conditions are likely. Ernesto is expected to weaken tomorrow. San Francisco Fed President Mary Daly told the FT that she has more confidence that inflation is under control. Even so, she argued for a patient approach to policy, saying, quote, gradualism is not weak, it's not slow, it's not behind, it's just prudent. She added that the economy is not in an urgent place and that while slowing, the labor market is not weak. Her comments come ahead of the Jackson Hole conference where Chair Powell speaks on Friday. And AMD has agreed to buy ZT Systems for almost $5 billion. The deal gives AMD data center technology. It's a direct challenge to NVIDIA's AI dominance. ZT makes server computers for owners of large data centers. It's the kind of customers that have been pouring billions into new AI capabilities. NVIDIA is still by far the chips industry leader in the AI boom, but AMD is seen as its closest rival and has been making inroads. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, rate cut bets weighing on the US dollar.
We've seen this movie before. We didn't believe it at the beginning of this year on the 6 interest rate cuts, right? We said that would get walked back. We didn't believe it at the beginning of 2023. You know, third time's a charm.
Seen this movie a few times, haven't we? Live from New York, you're watching Bloomberg TV. Live from New York, welcome to the program. Equity futures, your scores look like this on the S&P. We are totally unchanged, and the bond market totally unchanged as well, which I imagine after the last few weeks is probably a welcome thing for you all. Under surveillance this morning, rate cut bets weighing on the US dollar.
We've seen this movie before. We didn't believe it at the beginning of this year on the 6 interest rate cuts, right? We said that would get walked back. We didn't believe it at the beginning of 2023 when the Fed funds futures priced in 3 interest rate cuts for the back half of 2023. You know, third time's a charm. There's no doubt the Fed will go in September. I just don't believe the 7 to 9. And if you get 7 to 9, it's a problem for the economy.
So here's the latest. The US dollar extending losses as traders await comments from Fed Chair Jay Powell from Jackson Hole on Friday. Expectations for a September Fed rate cut helping to push the Bloomberg dollar index to its lowest level since March of this year. Steve Englander of Standard Chartered writing the following. We now expect 3 25 basis point cuts from the FOMC for the rest of 24. We also expect steeper rate cuts in the first half of 25, totaling 75 basis points in Q1 and 50 basis points in Q2. Steve joins us now for more. Steve, welcome to the program, and let's start right there with your calls for 3 cuts this year and 125 basis points in the first half of 2025. Can you help us and our audience understand whether that's an adjustment based on falling inflation or whether that's a shift to accommodation to confront weak growth?
More the first. If we really see weak growth, you know, which is not our baseline, but, you know, 50s are in the picture. The 50 story is a very, you know, a typical recession fall off a cliff story. We don't expect that, so we have 25. So I think as we get into 2025, with the unemployment rate drifting up and inflation getting closer to target, all the considerations of, you know, how tight should real interest rates be matter. So that's why we think that they'll be able to cut more aggressively and bring the Fed funds closer to neutral in the first half. I think the Fed would prefer not to do it in 2024 because they want to be sure we're still on track for, you know, getting target inflation, and they want to be sure if they do a 50 that the economy is in dire straits. But by 2025, they'll be more confident that they can do an isolated 50. We don't think it's going to be too many of them.
Steve, there are 2 very different conversations, though. There is a key distinction, and you've drawn it. The conversation about removing restrictiveness and a conversation about shifting towards accommodation. What does the dollar look like? How does it trade in one backdrop versus the other?
Yeah, the dollar is kind of interesting. We thought that the dollar would, because we're at saying 25 basis points. The market was somewhere between 25 and 50 in Q4. So as the market pulled back from those rate cut expectations, we thought the dollar would strengthen. What we've seen so far is that the asset markets and the currency markets are paying attention to the ebullience that you're seeing in equities. And, that's kind of been driving the dollar weaker, even though the interest rate moves have been more in favor of the dollar than against it. We have to see if that persists. There's still a long way to go before we entirely get rid of the 100 basis points, get back to 75 that we expect. So we as a baseline, we still think the dollar could nudge stronger. But 2025, we think, will be a weak dollar year, because that will be, all systems go to basically get back to neutral. The Fed will converge with everybody else in rates terms.
Does it bother you, Steve, that the bond market disagrees with itself? That essentially you have Fed funds futures talking about your view of things, 200 basis points of rate cuts by the end of next year. But then you've got a 2-year trading at 4%. I mean, you start talking about the dollar before you even get there. The market can't agree with itself.
Well, I never asked the market to be entirely consistent, because there are different segments in the market. But, the 2 years is kind of, pricing in that Fed funds, say by the end of 2025, beginning of 2026, will be around 3%. We're now at 5 and change. So the 2 years sort of averaging, where we are going to be versus where we are now. But I would say this, and I think this is really important. If it does turn out that we're in a typical recession, that, all the somber charts that on unemployment that everybody was pulling out, that this economy follows the contours of a typical recession, the market is way off base, because Fed will take real rates to 0, maybe negative. So that would mean like a 2% Fed funds rate or even below. I think right now the market is pricing in a very comfortable sluggishness in the U.S. economy that, mostly 25 basis point cuts can deal with. If it turns out that's not the case, we're mispriced, and we could go back to the early August world where, equities are mispriced because the economy is a lot weaker, and fixed income is mispriced because the cuts are going to have to be a lot deeper than, what's priced in now.
This raises a question going forward, and John was alluding to it, the idea of dollar weakness or dollar strength, depending on what kind of rate cuts there are. I'm wondering how much some of the dislocations or some of the overweights on the dollar versus the yen or things like that, how much those carry trades are really flushed out of the system last week, giving more of a clean slate that will lead to more controlled moves, not the same kind of violence that we saw.
From the indications we have, certainly what you call fast money, hedge funds, high frequency traders, they got out of their long dollar positions very, very quickly. So the market is pretty clean. There could be a few segments of the market where they're catching up, but I think that the positioning is much, much lower than it was 2 weeks ago or even a week ago, and it's certainly not in terms of dollar longs. Those have kind of disappeared.
Steve, just quickly, are you satisfied on a morning like this morning that we have broken the correlation between the Japanese yen and what happens with risk, given that equities are holding up okay this morning, even with a much stronger Japanese yen?
I'll say this. I never thought that the yen trade was what was driving global risk. It did drive Asian FX. I mean, that's why, all Asian currencies are strong. And it did drive the unwind. But I think that the big equity market moves that we saw and the big fixed income moves that we saw were driven by recession fears. And those could come back. It's not our baseline, but those could come back if it turns out that the unemployment rate keeps going up by 0.2% a month. And so we're not out of the woods yet.
We'll be playing this game again on September 6th. Looking forward to it. Steve, thank you, sir. Steve Englander of Standard Chartered. If you are just joining us, just a flavour, sneak peek of what's happening in foreign exchange. Against G10, the dollar is weaker against almost all of it, with the exception of the Canadian dollar. The Japanese yen, the standout here. Dollar yen with quite a move. Some real Japanese yen strength. Dollar yen down by about 0.9%. You look at what the equity market's doing, pretty much unchanged on the S&P 500. It's a welcome development for a lot of people who have been whipsawed in this market over the last couple of weeks.
It kind of goes to what Steve said, which is essentially a lot of the carry trades have been unwound. So a lot of the leverage that kind of would lead to that correlation where people would have to sell U.S. risk assets to bail themselves out of their carry trades that were getting blown up on the yen trade, that isn't as much of a present factor right now in markets. And I think that that's what this indicates.
Just get the feeling we're still only one jobs data point away from playing this game all over again, right?
Isn't that fun?
I know. September 6th. I think it's sort of circled on the calendar. For all of us, the second hour of Bloomberg Surveillance is up next. Here's your lineup. Matt Orton of Raymond James will be joining us alongside Bloomberg's Bobby Ghosh and Kelsey Berro of JPMorgan from New York. This is Bloomberg.
The labor market is still tight. The U.S. economy is still relatively strong.
Perhaps the Fed chair is talking the talk and walking the walk.
The Federal Reserve has a big decision in front of them on timing and, of course, the extent of the cuts.
We just maybe fade this idea that they're going to be able to cut as aggressively as what everybody else does.
I think these central bankers have to be careful with the power that they have.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and it's a much calmer morning following the better-than-expected data we saw throughout last week, both on retail sales and jobless claims and CPI. Just nothing scary in inflation for both CPI and PPI. That means your equity market is on a 7-day winning streak on the S&P 500. Coming into this morning, your scores look like this. The S&P 500 essentially unchanged. The Nasdaq down by about 0.1%. The Russell pulling back just a touch as well. The week ahead is absolutely stacked. It starts really on Friday with Chairman Powell. That's the top of the billing this week, addressing Jackson Hole. And then we kind of work backwards towards the DNC. But before we do all of that, Bramo, let's start with Chairman Powell on Friday. If this speech was conducted 2 weeks ago, the tone around this speech would have been so different to the tone around it right now.
The emergency rate cut that suddenly was necessary on a weaker than expected jobs report, how much does it differ from that type of tone at a time where there is going to be a Fed chair talking about rate cuts to respond to inflation, but nothing alarming that might seem like it indicates weakness in the economy? Look, there is a real question here about how effective their monetary policy is. And if they actually discuss that as their theme would suggest, I think a lot of people would be interested to understand how they understand their ability to really influence an economy very much hinging on other factors.
The backdrop always matters. Can you imagine what this would have looked like in Q1? Never mind 2 weeks ago. If we'd done in Q1 a Jackson Hole get-together and the title of that was the efficacy of monetary policy, we'd be talking about an economy that was less rate sensitive. We'd be asking questions about whether we need to go further. Remember, the conversation in Q1 of this year wasn't about rate cuts. We were taking them out. We were talking about the prospect of maybe another rate hike. Very different story, Q1, than where we are in the second half.
Which raises this issue of how much is the disinflation that's led to a very different kind of conversation because we're not seeing that kind of inflationary pressure from wages and a whole host of other factors. How much is due to Fed policy? How much is due to other factors that are independent of their control? Are they going to really be able to measure that in any kind of way? Will they present papers on that in some capacity? And then do you end up in what Nela Richardson was describing, which is any rate cuts going forward aren't going to really affect Main Street unless they become really extreme, but they will affect Wall Street, only widening that gap between asset prices and the main economy.
I have to say the timing of this Jackson Hole speech, I think, is fortunate, incredibly lucky. The evolution of the data has been quite favourable in their favour. The fact that inflation has continued to show some progress, some disinflationary trends progressing. On top of that, unemployment started to climb, but not too much. I think you can make the case, without coming out of left field, you can make the case at Jackson Hole this week that it's time to think about risk mitigation, risk management, the evolving balance of risks, and for that you need to reduce and take away some restrictiveness. It's quite an obvious message they need to send this week, isn't it?
And it's a message that's been pretty directly telegraphed by a host of different Fed officials who've been speaking over the weekend, who've been speaking over the past couple of weeks. Question now is, will that be enough? Given the fact that markets tend to take an idea and run away with it. And they have run away with the idea of a 50 basis point rate cut next week. What is the threshold for that? I don't think Jay Powell is going to come out and saying this is the balance of risks that we're going to go for 50 basis points, but this is what people would like him to say. And then in terms of how steep they can go, in terms of the neutral rate, I think is also an interesting idea, with Stephen Englander talking about dropping the rate, the real interest rate to negative potentially in the face of some sort of economic stress.
Projecting confidence has got to be an objective of the FOMC a little bit later this week. That's an objective of the DNC this week on the economy as well. And I have to say, just take a step back. Over the last week, they've struggled to project confidence around what they want to do with the US economy.
Absolutely, because they're coming out with this economic plan, and what everyone is focused on is this idea of price gouging, which Kamala Harris tried to herself clean up on Friday, saying all she wants to do is encourage Congress to basically say to the FTC there's a federal ban on price gouging when it comes to grocers. Because the issue is this has had serious pushback from economists who are even close to the Democratic Party. I look at what Jason Furman said, basically hoping that this isn't really an idea. The good case is price gouging is a message, not a reality. That's from your own camp. So they need to come out and say, we heard what you had to say. This is what really we're trying to do, because a lot of this is just thin on details. And Governor Gretchen Whitmer said, don't read too much into the price gouging. The issue is then you look at what the Washington Post said. Why put it out there if already you're being attacked that your policies are communist in nature from the Republicans? That's what they're saying. Then why talk about things like price controls?
Well, to me, this also just raises the issue of what do we actually know about what the policies are.
Not much.
Exactly. And so, if we're talking about the fact that no one's taking it seriously, what are people taking seriously? It's the deficit. And that's, I think, what we're going to see in terms of volatility in markets.
There's a pivot. Let's just stay on this for a further beat. I think design and implementation is really important. And we also have to acknowledge that to some extent this legislation already exists, particularly at the state level, and it can be very effective. So let's take the baby infant formula story, right? You have a big shortage in this country. In New York, we saw some retailers increase prices, jack prices up, and there's space for the state to step in and say you shouldn't be doing that. Okay, one. Design and implementation is going to be so important here. And without any real detail on what the design will be and what the implementation would look like, you've got no idea what the outcomes would be. So the outcomes could go anywhere from nothing to Soviet-style shortages and the like, and people lining up in food lines. These are the outcomes. And this is the problem of when you come out with a poorly informed decision just to throw out a line without any detail on design and implementation. And that's exactly what's happened with the Harris campaign over the last week.
If you take it a step further, there's a real question about how you become the party that allows business to thrive and the concept of being competitive in the United States, which is something that she put out there. How do you give that image if you're also talking about attacking profit margins, essentially, right? Is that what this is actually going after? What is the difference between profit margins and price gouging? Is there some sort of line that you can really identify? Are there parameters? These are some of the things that I think would be important to define whether this is anti-business or whether this is looking for specific policy prescriptions in cases that fall outside of the laws that already exist.
I spent a lot of time on the phone talking to individuals close to Kamala Harris when it comes to the economic policies. And they've asked me, Anne-Marie, what companies are calling you and telling you they're so worried about this? And I said, well, hold on. What companies do you think right now are price gouging? Because it was only a few months ago when this White House was touting that all of these companies, Walgreens, Walmart, Target, were cutting prices and listening to them, and that inflation and their policies were working. Inflation was coming down. Prices were working. This is an upbeat for the consumer. And you know what? They couldn't answer. This comes down to this polls well. And Kamala Harris is an incumbent. She is part of Bidenomics, whether she likes it or not. So instead of placing the blame on themselves, which the poll voters do, she's trying to put it on corporate America.
Don't you think it also reveals something about instinct here, Lisa? Instinct, statist intervention is the instinct of this ticket. It's hard to distance yourself from that when ultimately this is something you've thrown out in the last week. Think about it. There's nothing out there on policy. For a long time, we've talked about a campaign website that doesn't even have a tab to click on policy. There's nothing out there at all. And then you throw out something like this. That tells you a lot about where your instinct is.
Will they walk it back at all in the DNC? Will they be actually asked to by the ongoing party? It's a good question. And honestly, it's worth pointing out and talking about just simply because there is an absence of much else.
Let's turn to the scores. Equities right now on the S&P 500, totally unchanged, going nowhere in stocks. In bonds, going nowhere too, particularly over the last week at the front end of the curve. The 2-year still in and around 4.05%, the 10-year at 387.30. In FX, I just want to bring up dollar yen for you. Equities look calm. Dollar yen's delivering quite a move this morning, 0.9%. Lisa, 146.28 on dollar yen.
Yeah, as people wait for some sort of explanation of how much further the Japanese officials can go. How much, though, is this basically an acknowledgement that the yen can strengthen without the world falling apart? That essentially you have hedge funds that are going long the yen for the first time in a very long time after chronically shorting it and actually building up leverage positions. That's what this indicates to me, because the world is not falling apart, and yet we do see yen strength.
This is not what this story was just a couple of weeks ago in foreign exchange and in equity markets. Your lineup this morning for the next hour or so looks like this. Coming up, we'll catch up with Matt Orton of Raymond James with the S&P 500 on a 7-day winning streak. Bloomberg's Bobby Ghosh as peace talks stall in the Middle East, and Kelsey Berro of JPMorgan Asset Management ahead of that speech from Chairman Powell in Jackson Hole. We begin with our top story. Stocks coming off their best week of the year as traders await Fed Chair Jay Powell's remarks on Friday. Matt Orton of Raymond James writing this: I expect Powell to more explicitly set the table for the start of the rate cutting cycle in September. This is consensus now, and the key question is, by how much will they cut? My base case is 25 basis points. For more, Matt joins us now. Matt, let's talk about your theory on where we are at the moment. Slowing but not breaking. Is that sufficient for equity markets to continue grinding higher from here into year end?
Hey, good morning, John. And I think it is. I think the fact that we're starting to get normalization on the inflation front, that growth is starting to come back down to what we more expected it to be, but still be positive. I think that's generally very positive for the equity markets, because you can start to expect a rate cut. You can start to read through of how gradual this might be. And most importantly, it gives you more visibility with respect to corporate earnings. We just haven't been talking enough about how resilient corporate earnings have been through all of the volatility, with different narratives, with what's happening to the consumer, global growth. Corporate America has done very well. And what is most encouraging to me as an investor is that I'm seeing the broadening of earnings growth that has been playing out over the past 2 quarters continue so far in the second quarter. And you're finally starting to see that translate a little bit into price breadth as well. So you're seeing more sectors start to work despite the big events over the past couple of weeks. And that gives me encouragement when I talk to clients to say, look, I think when you have downside volatility, that's a great opportunity to use that volatility to better position your portfolio for a more normalized growth environment. So that means you can own a number of different sectors, not just information technology or comm services going forward.
Matt, just go a little bit deeper. When it comes to breadth, what is most encouraging for you? What part of the equity market, and what tells you that the earnings story there in that pocket, wherever you might choose, is more durable going forward from here?
You know, John, what's been most encouraging to me is you've seen resilience and an inflection point in earnings for financials. And that's finally started to translate to price, not just of insurance companies, but you're seeing a lot of the money center banks start to do well. You're starting to see the regionals reflect a little bit of optimism with respect to a rate normalization environment. That's very, very healthy. And you're starting to see deal flow come back to the market as well. So M&A is picking up, particularly down market cap. So that's an area of encouragement to me. And you've also seen very positive surprises in sectors like healthcare, utilities, real estate. Those are all parts of the market that really haven't performed for a very, very long time. But you're finally starting to see things work outside of just GLP-1s. HMOs are finally starting to work a little bit more. That resiliency is translating into price breadth. And that, when I talk to clients, those are parts of the market I'm encouraging them to lean into, because valuations are still very, very attractive.
Matt, one thing that you point out is that we have seen expansion in profit margins, and you said that that gives you confidence that we're not going to see mass layoffs in the near future. How do you distinguish, Matt, between the idea of healthy profit expansions versus squeezing blood from a stone, or price gouging, or some of these other kinds of political hot potatoes?
You know, price gouging is the word du jour, I guess, after the economic policies were announced last week. But I just don't see that going on. When I look at a lot of the corporate income statements and balance sheets for the companies that we look at across our company, what you're seeing with respect to profit margins is that companies are being more innovative. I know we complain about not seeing enough of AI monetization, but when you actually look beneath the surface out of the mega cap space, you're starting to see more efficiencies come from companies that are dabbing their toes with respect to artificial intelligence to drive increased productivity. On top of that, you're seeing wage gains start to normalize as this disinflation and disinflationary environment continues. So that's also giving companies the ability to better make profits while keeping prices a little more consistent. And on the services side, you're still seeing prices increase, but in a normal environment, and you're not seeing the dislocations that really caused the issues that have led to inflation over the past few years persist. So, you know, disinflation hasn't decimated our ability to generate profit margins. And that is a very important message for customers going forward, is that you can have confidence that there is resiliency there, that we're not seeing that story fall apart like a lot of folks expected.
Does this picture of resilience jibe with this idea of 200 basis points of rate cuts by the end of next year, which is basically what the market's pricing in?
Yeah, not to me, Lisa. I don't foresee these mass rate cuts that a lot of the markets started to price in really aggressively after, the volatility over the past few weeks. Given the fact that the economy is slowing, we're not heading off of a cliff. I think the totality of the data does not support that, and especially what we heard last week. So I would be very surprised if there was a 50 basis point cut coming in September, because it's just not justified based on where we are. And I think the market needs to rethink the depth of rate cuts that need to happen, or at least the pace at which we get there, because again, it might not be justified with where we are and the fact that there are still sticky components to inflation. Look at housing. That's been a problem area. You're still seeing issues with respect to insurance prices. You still do see some wage gain. So there are still issues that Fed has to deal with, but they can take cover and I think start to cut in September.
Matt, Lisa mentioned price gouging. Can you give us a sense how politics are playing into your investment playbook?
Anne-Marie, I get this question a lot from clients, especially with election season coming. What do I do to position my portfolio for whoever I think is going to win this election? And my answer is the same to every single client. It's don't. Just don't try to do it. What I try to look for and encourage our investors to look for are secular growth themes that are really going to be durable throughout whoever ends up winning this election. And there's a lot of those themes out there. I tend to point to artificial intelligence 2.0, which is really who are the CapEx beneficiaries of the hyperscaler spend. I mean, we've seen over $200 billion of CapEx committed just over the next year alone from 4 single companies. That's a lot of money to go around and a lot of visibility with respect to earning streams for companies from industrials. Your electrical equipment makers look very, very attractive. Defense is a global theme, and defense tends to do well heading into an election season, no matter what way that you're leaning. So there's a lot of pockets you can lean into to try and avoid the noise of politics and then sift through the dust once we actually have a tangible outcome.
Well, one thing is clear. Both these candidates want to spend next year, and there will be tariffs in some form, either a continuation or the walls are going to come up much higher. In that sense, are you worried at all about the deficit?
I think the deficit's one of those issues. What do you say? You'll know it when it actually matters. And I think I don't mean to downplay the severity of the challenges, but I think based on where we are right now, it's not going to impede, I think, some of the themes that are driving this economic cycle for at least into the medium term. That said, what we do today will set the stage of how severe some of those issues coming home to roost will be in 3-5 years down the road. So I do encourage investors to think very carefully about what those policies are going to do. And again, on the issue of tariffs, it's just yet another reason why I don't like China as an investment theme. I think there's so many other opportunities across emerging markets and international developed markets for investors to get diversification in portfolios. You don't need to play the China game because, as you pointed out, Anne-Marie, tariffs are a universal issue at this point.
Hey, Matt, good to hear from you. Matt Orton there of Raymond James. On the global outlook, just on the debt and the deficit, 20-year bonds coming this week. This is for Lisa, $16 billion worth. 30-year tips reopening as well, $8 billion worth a little bit later this week.
When will we find out when people care about the deficit? I mean, I think about the deficit, which is Steve Eisman's moniker of all of the longstanding fears about the deficit. At some point, it will matter. And this really is the key question for me. Not necessarily shifting the borrowing costs in a significant way, but causing this ongoing volatility that we were talking about last week is kind of the new normal. I mean, we're seeing such volatility in 10-year, 2-year Treasury yields. Is that kind of what we can come to expect, not only with questions around inflation, but also the fiscal backdrop?
Making auctions great again by Lisa Bramford. So let's get you an update on stories elsewhere this morning. Here's your update, your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Israel and Hamas leaders are blaming each other for a stalled ceasefire and hostage deal. Israeli Prime Minister Benjamin Netanyahu accused Hamas of being completely obstinate, while Hamas said Netanyahu is fully responsible. U.S. Secretary of State Anthony Blinken is in Israel now, meeting with top leaders. Earlier today, he said that this is a decisive moment and maybe the last opportunity. The U.S. said talks on a Gaza ceasefire are in the final stages. And European airlines are outpacing the U.S. on cleaner jet fuel. That's according to a Bloomberg Green analysis. In part, it's due to a government mandate. The EU will require airlines to use 2% sustainable aviation fuel starting next year. Estimates from the International Air Transport Association show that most airlines are lagging far behind their pledges. Their use of sustainable fuel grew just under 0.2% in 2023, but that is up from 0.04% in 2021. The ports of LA and Long Beach, which account for nearly a third of all U.S. container imports, are seeing a frenzy of volume. It's rivaling the highest import levels set during the pandemic. The volume stands in contrast to concerns over a cooling economy. Instead, retailers are stocking up ahead of a potential U.S. tariff on Chinese goods and a potential strike by American dock workers. Though there is a threat that consumer spending weakens meaningfully, leaving warehouses full and companies with too high inventories. And that's your brief, John.
Some of those numbers reported over the weekend, just absolutely staggering, phenomenal. Thank you, Danny. As always, up next on the program, Donald Trump's swing state offensive.
Starting the day I take the oath of office, I will rapidly drive prices down and we will make America affordable again. We're going to make it affordable again.
New tagline, that conversation up next, live from New York City this morning. Good morning. Welcome to the program. 7-day winning streak on the S&P 500, looking to make it day 8. Equities just about positive on the S&P and yields just about lower by a single basis point. The 10-year 387.30. Under surveillance this morning, Donald Trump's swing state offensive.
Starting the day I take the oath of office, I will rapidly drive prices down and we will make America affordable again. We're going to make it affordable again. Under Kamala Harris and crooked Joe Biden, the American dream was dead, and it is dead. It's dead as a doornail. They'll never bring it back unless we win.
Here's the latest. Donald Trump hitting the campaign trail with a full week of DNC counter-programming. Trump hosting rallies across swing states and making a visit to the U.S.-Mexico border on Thursday, the same day Harris is scheduled to give her acceptance speech at the DNC. It's been a complaint over the last week of Republicans around the campaign, inside the campaign, about their nominee. Can he remain disciplined enough to stay on topic on immigration, on the economy?
They don't want him veering off into attacks against Kamala Harris. They don't think that polls well, and they think that actually makes independent voters say, oh, I don't like this again. I don't want another 4 years of these grievances and personal attacks back and forth. What they want him to talk about are the things he polls well. He polls higher. He was polling higher than Biden. He's polling higher than Kamala Harris when it comes to the economy and when it comes to immigration, which is why Thursday is going to be interesting. This is proper counter-programming. Remember, she was given this task of looking after the root causes of immigration. Some journalists ran with that and called her the border czar. Then they now are starting to walk that back, saying she wasn't the border czar. The exact quote from the White House is she's going to be looking at the root causes. The Republicans say, no, you called her the border czar then, it didn't work. And this is one of the biggest problems facing the Harris ticket. It's the economy and it's immigration, and Trump's going to try to stay on message. I think the campaign wants to stay on message as best he can this week.
There's a fissure, though, that's emerging within the Republican Party right now. And it's not just with Trump and whether he should stay on message. It's within the party and whether his advisors are making the right kind of plea to go more moderate, to cater to independence, and whether that's fair, given the fact that a lot of people are saying actually lean into what's made you as popular as you are, which is your base. And you can feel that tension coming to the fore with calls to potentially replace the likes of Corey Lewandowski. But this is, to me, something interesting to watch in terms of who Trump listens to. Is it the growing number of commentators who are saying, stop it already, go back to what you used to do, or his own advisors?
You know, it's funny, we talk a lot about the differences between these two candidates. There are many. But can we talk about the similarities? We've got Kamala Harris effectively copying one of the policies that Donald Trump would like to introduce, no taxes on tips. It's a very big difference in language between the vice presidential candidate on the Republican side and what we're hearing from the current vice president, Kamala Harris, on child tax credits. You've heard from J.D. Vance, who's basically said people who have kids should pay fewer taxes. I mean, the policy already exists, but then Kamala Harris comes out and says we want a bigger child tax credit. When it comes to tariffs, Harris is saying it's a Trump tax. I don't hear anything from the Democratic Party about removing the tariffs that already exist. They've stayed on through the Biden administration. So I think we have to take a step back every time we do this. There are massive differences, but there are a lot of similarities between what's on offer here as well from both parties.
Absolutely. What's clear to me is that next year, the child tax credits may be going up. That has bipartisan approval, but this is populism on both sides.
Big time. Coming up on this programme, we'll catch up with Bloomberg's Bobby Ghosh with peace talks stalling in the Middle East. That conversation up next from New York. This is Bloomberg. This just in from Berro. She says that if they get rid of taxes on tips, she will pay less in tips.
Oh, whoa.
Restaurants across the country.
You're going to put this on me.
This just in.
Okay. I think a journalist was around the table.
Critical analysis from Berro. Says she's going to get a spreadsheet and work out what would still be consistent, just in terms of what she's offering, if they get rid of the tax. Quite a take from Lisa, just moments ago in the commercial break.
Really?
Equity futures right now in the S&P 500.
Hey, that was totally what you were saying.
I was raising the question if people would actually do that. Would people do that? Would you do that? Would I do that?
I don't
Equities
think
right now in the S&P. I mean, maybe you could.
Well, guess what?
You couldn't.
Guess
Maybe
what?
you could.
The policy.
No. Maybe you could.
It's not happening.
You don't think it's happening?
No.
Why don't you think it's happening?
Because this would be very difficult to get through Congress. 1. 2, would it actually be effective given the tax rate people that normally work in this industry, they're already the rate they're at. They're already mostly not paying that income tax. 3, the loopholes that potentially be used against this, so Democrats would not vote for. AKA, if you're a hedge fund, could part of your pay now be given, say, a bonus as considered a tip, and then you don't have to pay taxes on it.
Newsflash, the only reason why that's okay is that nobody believes that I would lower tips. Nobody thinks that I would go that low. That is not in character. That is not how I would act. I think that I would continue to do 20%.
You think you have the personality of a good tipper?
I do.
Is that what you're suggesting?
Well, I am a good tipper, so I think that I do have the personality of that.
No, just wondering.
Yeah.
Just wondering.
I think I take pride in that.
Do I have the
think it's
personality
important.
of a good tipper?
You do, but I think that you could adjust.
Well, it depends.
Continue.
Put an endorsement of someone's personality if you believe they have the personality of a good tipper.
I agree. I think that if somebody's really a penny pincher with the way that somebody treats them, I think especially if they have the capacity to pay, even with tax-free, I don't think that they would adjust it.
I will settle this. Do you tip on credit card or do you give cash?
Oh, I don't carry cash.
Okay, well now I'm judging both of you.
Oh, you carry cash to tip?
Sometimes, yeah.
Okay.
Sometimes. All right, self-righteous.
I don't know how we got into that. What's that about? That's very self-righteous. You carry cash just to tip.
Well, then
you go out like for a coffee. I've been for coffee with you. You never tip. What are you talking about? Equities on the S&P. Just about positive here. Seriously, never seen that in my life. What's she talking about? On the Nasdaq, just about positive as well. 7-day winning streak on the S&P 500. Incidentally, the longest winning streak on a daily basis, only going back to July. So it's not the length of this winning streak, it's the size of the gain over the period that's pretty phenomenal. We're talking about a move of 6.8% higher over that period, and the best such run, Lisa, going back to 2022.
Just what a whipsaw, and this came without some massive sell-off in the bond market. That's what I find interesting. This is without reassessing whether steep rate cuts will be necessary. So the economy can be good and you can get lower rates because of disinflation, and that seems to be where we're at in markets right now.
If you switch to the bond market, just turn a page and switch on the board. The 2-year pretty stable over the last week or so. Yes, a lot of movement in between, but from point to point over the last few Fridays, 4.05%. 2 Fridays ago, 4.05%. This morning, we're kind of anchored at the front end now, Lisa, as we drift towards Jackson Hole and we continue that conversation about whether it's 25 or 50 at the September Federal Reserve meeting.
One thing's been lost over the past couple of months, and that's this idea that the neutral rate might be 4% or 5%. Nobody's saying that anymore. People are saying now that the neutral rate is back down near where it was before, maybe a little bit higher, but there is this feeling that the Fed has more room to cut than maybe 6 months ago, which is a new, and for the stock market, beautiful thing.
First message I got on the Bloomberg terminal, aren't bonuses tips? To your point, straight away. Bloomberg subscriber. I'm sure they've got their own pay in mind.
I mean, you have to think, then they're basically saying to their company, do I need to be taxed on this? And this is where the conversation is going to go.
Exactly. Employees are going to say, those extra bonuses we get, that is technically a tip. And then they're not going to want to start to pay taxes on this.
This conversation, of course, connected to the bond market because we hear all these proposals and hardly any connection to policies about revenue raises. What's going to happen with the Trump tax cuts from a couple of years ago back in 2017-18? Who's going to push them forward? Donald Trump says he will. Are they going to expire under a Harris presidency? Will elements of it expire? Have they been clear on that?
Basically, there have been a couple of studies done about how much the deficit increases under both Harris and Trump. And basically, it does increase under either of them. Exactly how much has been different. It ranges from $1 trillion to $7 trillion. A lot of people say that actually the Trump plan probably increases the deficit more than the Biden plan. There's a lot of disagreement on that. There's sort of a political discussion around the political analysis of proposals that are really lacking in detail. So all of this, nobody's going to say we're going to reduce the deficit, which is a reason why we're going to make auctions great again.
Making auctions great again with Lisa Abramowitz for the year ahead and maybe the next several years, waiting for that big moment. Dollar yen at the moment looks like this, 146.20. This is such a snarky market check. 146.20 on dollar yen. We've got to move of about 1 full percentage point, so a much stronger Japanese yen, and we haven't got a breakdown in risk. And I think that development or lack thereof is really important on a morning like this morning compared to where we were a couple of weeks ago. That's some of the price action for you. Under surveillance this morning, Vice President Kamala Harris holding a narrow lead over former President Donald Trump in the latest Washington Post ABC News Ipsos poll. Harris standing at 49%, and Marie with Trump at 45%. And swing state leads, we've seen this repeatedly. This is a tight race away from that poll. From the national horse race, you go to the swing states, this is still super tight.
And there was one over the weekend from the New York Times, Siena College, and it shows how quickly Harris is able to really try to shore up and tighten that race when it comes to the Sun Belt. Talk about tax on tip. This is a pure political play in a state like Nevada, where the hospitality industry really trumps everything else, and they're vying for those votes. When you look deeper into the poll, especially that Washington Post ABC poll, yes, she's tightening the race. She's even winning slightly. But look at the top two issues. Trump still has the advantage, the economy and immigration. And that is why some members of his campaign really want him to stay on message.
Let's see if he can do that. It keeps coming back to those two issues. Let's pick out one of them, the economy. Goldman Sachs lowering recession odds this year to 20% from 25%. Economists citing last week's retail sales and jobless claims data, adding that if the August jobs report looks good, they would probably cut that number back to 15%. So it comes back to that date on the calendar all over again. It's September 6th, and it's the August payrolls report, Lisa, before September 11th, when we get the CPI report, and then a week after that, a Fed decision.
Let's just put that into perspective. They increased the recession forecast on August 2nd. It is August 19th. They are revising down that increased expectation based on data that we received in that time frame. You asked me earlier, is there any possibility of a narrative shift? I would argue, is there any possibility of not getting a narrative shift between now and September 18th, given the fact that the economic data has been all over the map? Also, with the revisions on Wednesday, we have to keep going back to that. All of the data that we get gets revised. So the payrolls numbers that we get, we're going to see the backward-looking revisions that mesh it with some of the payroll surveys that are done through other indicators. To me, this just highlights the fuzziness of being data-dependent on unreliable data points.
We've got to remember, though, that growth scare didn't just happen in isolation around one single jobs report. It was also jobless claims. It was also a spooky ISM manufacturing read with a very, very depressing employment component in all of that as well. If you get a increase in unemployment again on September 6th, but the rest of the data looks pretty decent, will people be willing to discount that? Do you really think we'd go back to that growth scare at the start of this month all over again?
I don't know. It depends on what happens with the carry trade and what happens with some other random trade. I mean, honestly, it's a good question. And I think that it's important to ask, right? What's the perfect recipe to lead it to a growth scare? What's the perfect recipe to allow a Fed rate cut for the right reasons? I don't know the answer to that. And frankly, markets don't know the answer to it because it's been different every single time. At this point, to even read into what we saw as a growth scare versus a carry trade unwind versus just simply markets that got too overpriced, either way, what we can see is a Federal Reserve that's going to try to set a message that allows for all of this, but to give them some control back, because right now they have kind of lost the plot a little bit when it comes to giving forward guidance.
We keep going back to that word calm. Things are calmer compared to where we were a few weeks ago, supported by some of the incoming data over the last week, both retail sales and jobless claims. I want to turn to this story. Israel and Hamas blaming each other for stalling a ceasefire and hostage deal. US Secretary of State Antony Blinken is in Israel right now, meeting with top leaders before heading to Egypt tomorrow, with talks set to resume in Cairo later this week. With us around the table, Bloomberg's Bobby Ghosh joins us for more. Bobby, good morning to you.
Morning.
So there's two sets of talks here. There's a set of talks between Israel and trying to work out what happens in Gaza. There's also a set of talks, Amos Hochstein, who we'll catch up with later, between Lebanon and Israel, coming to some kind of truce as well. How connected are those two talks at the moment for you?
They are connected in that the overall objective of all of these talks, and the reason why Blinken is there, is to try to bring down the temperature across the whole region. Israel's assassination of a top Hezbollah leader in Lebanon raised the stakes. Then Israel's assassination of the Hamas chief in Tehran raised the stakes even more. So it matters because of those reasons. But for the moment where everyone is focusing their attention, Blinken and the Biden administration certainly, is on the ceasefire talks over Gaza. Now, Blinken this morning, and perhaps even while we speak, was meeting with Bibi Netanyahu and other top leaders. Going into those meetings, he's used what for me is surprising language. He's been saying things like, this is the last opportunity for a ceasefire talks, the last opportunity to bring the hostages back. That is pretty strong language in diplomatese. It also puts the Biden administration in this awkward place. If Blinken comes back empty-handed from this trip, this is trip number 9, number 10, if he comes back empty-handed, having already described this as the last opportunity, where do you go from here? What we're hearing from the two main protagonists, both from Hamas and from the Israelis, each is blaming the other for stalling the talks. Hamas is saying Netanyahu is making new and impossible demands. Netanyahu is saying Hamas keeps asking for more. In private, or speaking to journalists off the record, the Biden administration has been saying things like, it's mostly Bibi's fault. In private, they blame Hamas, but in public, they blame Hamas. In private, they've been saying, this is mostly Bibi's doing. Reports from Israel are also blaming Bibi Netanyahu. There are polls coming out of Israel saying the Israeli public in a sizable majority, 60-some%, want a deal now. But Netanyahu has consistently disregarded what his own people are saying and what the Biden administration is saying. So his position that he's not going to move does not seem to have changed.
Can we pick up on the language? You've identified that as being somewhat surprising, perhaps even important. It begs the question, where's that coming from? Why is that language being used?
It's coming from frustration. The Biden administration has been pushing for this deal for months now. It comes from, I suspect, a last-ditch effort, diplomatic effort to try to get both sides to focus. And certainly try to get Bibi Netanyahu to focus on this. No matter how much the Biden administration has pushed him to do so, he has not done. He's been more interested in the actions of the Biden administration than the words. And the actions, frankly, reassure him. The Biden administration has continued to deliver to Israel all the arms that it needs to continue this offensive. And as long as he keeps getting the weapons, I don't think Netanyahu is going to actually move his position at all.
Bobby, last week, the president basically insinuated that these ceasefire negotiations could potentially mean no retaliation from Iran. We have the foreign ministry of Iran coming out today and saying that's not correct. These are not directly linked, and Iran will retaliate. Where are we in this retaliation? Because last week, when all the weaponry was going to the Gulf, everyone thought it was going to be immediately, and so far we haven't seen anything yet from Tehran.
Well, I think the Biden administration was throwing a Hail Mary pass last week when it said exactly that. Where the Biden administration gets the confidence to speak for Iran, I don't know. This was Iran reminding everybody, and especially Washington, we make our own decisions, we have our own timeline, our own agenda. You don't get to speak to us. That's what Iran is saying here. But Iran doesn't want a war. It didn't want a war with Israel over Israel and the United States. That's a working assumption. It did not want a war over the killing of Iranian civilians, top Iranian scientists, and the sort of perhaps the most important Iranian general, Qasem Soleimani. It's not going to want a war over the leader of Hamas, however important he may have been. It will retaliate in some way. I suspect that the longer this goes on, it gives Iran license for a smaller retaliation. And we saw this with Soleimani. Immediately after the Soleimani assassination, there were rockets fired in the direction of American bases. And then they, for a long time, continued to say, we're not done yet. We have not yet taken revenge for Soleimani. We'll come after the United States in a big way. In the end, that didn't happen. So the longer Iran sort of allows this thing to slide, it is hoping that it buys itself license to make a smaller, more symbolic attack.
Bobby, it was great to set the stage with you this morning. Appreciate it. Thank you, sir. Bobby Ghosh there of Bloomberg, setting the stage for a conversation that will continue in about 30 minutes with the President's advisor, Amos Hochstein. Look out for that around 8:15 Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Corporate America is attempting to hedge their bets on who will be the next U.S. president, according to FT reporting. Fewer CEOs are opening their wallets this time around. Federal Election Commission data show that as of June 30th, just 5 of the 221 members of the Business Roundtable have donated to either candidate. That doesn't mean companies are ignoring the election. Since July 1st, 319 U.S. companies have mentioned the election on their earnings call. That's nearly double the number from 4 years ago. Minneapolis Fed President Neel Kashkari is open to rate cuts in September. He told the Wall Street Journal that the balance of risks have shifted. In a change from his tone in June, he had said then that a rate cut might not be necessary until the end of the year. Kashkari said the conversation has shifted because, quote, inflation is making progress and the labor market is showing some concerning signs. X is shutting down operations in Brazil while keeping the service available in the country. A post from X's Global Government Affairs Department said that Brazil's Supreme Court Justice Alexandre de Moraes threatened the company's legal representative with arrest if X did not comply with censorship orders. In a separate post, Musk said the decision to close the office was difficult. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, we're counting you down to Jackson Hole and the Fed's annual get-together, with equity futures just about positive on the S&P, coming off the back of the biggest weekly gain of the year so far. Equities on the S&P 500 coming off the back of a 7-day winning streak and looking to continue such streak with an 8th day potentially. We're positive by just 0.03% on the S&P 500. In the bond market, yields just about lower by almost a basis point on a 10-year 387.30. Under surveillance this morning, counting down to Jackson Hole.
The Fed has a real opportunity here to sort of shift the narrative. And I would argue that they're starting that process now. You know, when Powell finally shifted to focusing on labor over inflation, which I would argue was long overdue, I think that's step one. And I think the next step is, hey, look, we don't think that things are really sort of slowing in a notable way, but we recognize that policy is calibrated for a completely different inflation regime than what we have right now.
So here's the latest. All eyes on Fed Chair Jay Powell as he's set to speak Friday from Jackson Hole. The focus turning from when to how big and how many rate cuts the Fed actually delivers. Kelsey, Berro of JPMorgan Asset Management writing the following. Simple policy rules would suggest the Fed could have already started easing by now. This was true even before the last jobs report, but further confirmed by the most recent CPI report. Risk-reward favours owning some duration in portfolios as we approach the start of the Fed's easing cycle. Kelsey joins us now for more. Now, Kelsey, language is really important. You say easing. Some people might say removing restriction. Are you talking about a shift towards accommodation at the Federal Reserve?
Well, I think you are rightfully so picking up on a little bit of a differentiation. So when I say easing, I think the Fed in their mind views that as reducing policy restrictiveness. But I think when I look at the environment more holistically, putting aside the conflicting noise that we're hearing in terms of the labor market and the consumer, is it really weak or is it really strong? I think the inflation backdrop alone at this point probably justifies at least 100 basis points of rate cuts, not immediately, but I think a policy rate closer to 3.5% to 4% is probably where we should be trending just based on the inflation data alone. And that's because inflation is coming down. It's more broad-based. It's really just concentrated in two categories at this point, shelter and auto insurance.
Let's get into that a little bit more, sort of set the stage for the economic backdrop, and then we'll get into the market call. The breadth of the decline in inflation, how encouraging has that been for you? Where is shelter? Is that still a sticking point?
It has been very encouraging. I mean, so if you think about the inflation or disinflation that we saw last year, it was primarily a goods story, and that was the low-hanging fruit. What we've seen more recently is that the inflation or disinflation has broadened out, and it's now included the services category. Now, the shelter category, I know there's a lot of hemming and hawing over, is it coming down? Is it coming down fast enough? But, I look at it, I look at the year-over-year rate, it's down 300 basis points, 3% over the last year. It's coming down, and I think it will probably continue to normalize over time to levels more consistent with pre-COVID, which is where the majority of the CPI basket is already trading.
You've been talking about this for many months. Basically, the rest of the market's come on board with you. And it seems like this is now consensus, and the market is pricing this in already. And some would argue has already moved for the Federal Reserve, which hasn't moved, and yet effective rates have essentially dropped that much. How disruptive would it be if Fed Chair Jay Powell doesn't lean into the rate cuts that are being priced into the market in his speech on Friday?
Yeah, that's a really good question because, I look at the moves in yields this year, right? And they've all been driven by data. Not one has been driven by Fed speak. It's the data that's driving the market's reassessment of how many rate cuts need to be done this year. And earlier in the year, when there was concern about reacceleration risk and there were a couple hot inflation prints, the market priced out rate cuts. They didn't need Fed speak to do that. So I guess where I'm circling back to is when I think about Jackson Hole and what Chair Powell's responsibility is, I think what we're going to hear from him is that he is comfortable with the inflation backdrop. This is an environment where the Fed can start removing policy restrictiveness, but I don't think he is going to be particularly explicit about how many rate cuts that will be or how far they need to go. I think that they're going to kind of continue to let the market do that work for them.
So in other words, he's not going to lean into it one way or another, which raises this question about the theme of the actual conference, which is reassessing the effectiveness and transmission of monetary policy. How effective and how much control do they have over the transmission of this monetary policy if all of the moves this year have not been driven by the rhetoric, have been driven by data?
Right. Well, I think that's because we've moved out of an era of true reliance on forward guidance. If you think about what forward guidance was and why it was created for an environment of the zero lower bound, right? It was when we cut to zero and we still needed to be even more accommodative and we had no tools left and we've tried quantitative easing, 1, 2, 3, what else can we do? Well, we can try to just jawbone the markets and continue to promise them low rates for longer. The environment we're in right now is not really an environment of extraordinary policy where the forward guidance that we need is that type of forward guidance. And so I think that the environment that we're in is one rightfully so where the forward guidance is not what's most relevant. What's most relevant is where we are in the business cycle. And to be frank, we're all learning that together, including the Federal Reserve members, as they watch the data.
Kelsey, when you were talking about the data and the market moving data dependent, that's because the Fed told them they were so data dependent. So it comes from the Fed basically saying, we're so data dependent, the market should be data dependent. Does Jay Powell need to almost take a step back on that when he talks in September this week at Jackson Hole before the potential cut or keeping policy in line? Take a step back on the market, you shouldn't be so data dependent?
So I do think there's probably an opportunity for him to use words such as gradual to describe the easing cycle. So he's likely aware that commentators in the media and financial market participants have been talking about the need for intra-meeting cuts after the July jobs report, the need for potentially 50 basis point rate cuts. I think the data he's seeing on a mosaic basis is probably not suggesting a need to be that quick to move. And so while I think he wants to communicate that they have the capacity to be quick, if necessary, the current environment is one where they can adjust slowly and recognize that in the event that something goes wrong, we're in a great position to respond because we're not near the zero lower bound. We have 500 basis points of policy space. And that's also, I think what the bond market is picking up. And while yields are coming down, spreads are also staying very well contained.
I just want to say this up front, present company excluded. The last year has been dominated on this program by a bunch of people trying to sell some bond funds and to get out of cash. And I hear it again now, sort of scaring people out of cash to say the rate cuts are coming, extend duration, get out of money market funds. Why is now the right time to do that? Because I've seen head fake after head fake over the last 12 months when people have given up, say, 5.5% and rushed out to buy duration when they maybe didn't need to. Why is now the right time? Why is now different?
Well, I mean, I was just looking at the numbers myself, and, I said, normally the conventional wisdom is once the Fed is done hiking, which was back in July of last year, it's time to start extending duration. If you were to have moved just a little bit of that cash into 1 to 5 year high quality corporate credit, so 1 to 5 year investment grade credit, you'd be 200 basis points ahead of cash at this point, 13 months later. So I think the proof statement is actually already there. And that's before the Fed has even started cutting.
Kelsey, Berro of JPMorgan Asset Management defending that sales pitch of the last 18 months. It wasn't aimed at you. Anyway, it was aimed at everybody who's made that pitch. Hear it again and again, don't you? If you are listening, you're thinking, I've been sat in cash, I've been receiving 5%. Should I shift out? Is now the right time? Are those rate cuts really coming? Is that 100 basis points of cuts just around the corner?
They said it 6 months ago. Now they're saying it now. The interesting thing is the delta between people who say go into 1 to 5 year or the people who say go into 10 year. Fewer and fewer people are saying going into 10 year.
Yeah, hear more about the belly of the curve.
Yeah.
I agree with you on that point. Up next, the third hour of Bloomberg Surveillance with Jim Caron and Morgan Stanley, Senior Advisor to the President, Amos Hochstein. We'll catch up with Lindsey Piegza of Stifel and Mike Schumacher of Wells Fargo.
We've got a good situation here. Things are indeed getting better.
You're still seeing that some of that U.S. exceptionalism is still there.
While we look at the earnings data that is in front of us that looks to be quite positive, as we look ahead at the second part of the year, we're not quite as optimistic.
I wouldn't mind if things just kind of simmer down a little bit. And I think they will.
You've got all these disconnects that I think markets have to reconcile themselves with.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are 90 minutes away from the opening bell, and the third hour of Bloomberg Surveillance starts right now. So let's start with your scores on the S&P 500, totally unchanged. Likewise on the Nasdaq 100, pulling back just a touch on the Russell. The small caps down by around about 0.1%. We've talked lots about the week ahead. We have to start the conversation again this hour with Chairman Powell in Jackson Hole, Wyoming, delivering that big speech at the annual get-together over at the Federal Reserve. A bigger speech after the conflicting data we've seen over the last month.
And increasing expectations for at least a 25 basis point rate cut next month, if not a 50 basis point rate cut. Let's just frame it as this. After a tumultuous couple of weeks, pretty much everyone out there is praying that it will confirm what's going on in markets so they can go on vacation for the rest of the summer, because that's essentially what I hear from pretty much every single person and what I'm reading in the notes. By the way, I'm not going to be here after the Jackson Hole speech. So how much is this basically, please confirm that it seems like we're on the same page and that we can all go on vacation?
Do you think he needs to validate market pricing? Do you think he needs to go that far, or just validate the idea that they will be reducing interest rates in September?
That they will be reducing interest rates in September. He can talk about other issues, et cetera, but it's not going to be, a prescriptive type of speech. It's going to be a philosophical one, the type that I really love. It's not going to be the pain speech where he comes out for 8 minutes and says, pain, pain, pain. He's going to come out and talk about, the balance of risks and all sorts of other things. It's going to be maybe less declaratory than it has been in the past.
So not mission accomplished, but maybe a risk management story. Let's reduce interest rates and get ahead of potential weakness.
That was much better said. Than
it feels like that's the arc of the Fed speak over the last couple of months anyway.
Yeah.
So that's not going to feel too jarring. It feels like that's where this is going to land.
And the idea of preemptive rate cuts, I think, will come into the fore. The idea of landing this sort of soft landing, how do you do that? You have to get ahead of the weakness and really cut rates in tandem with inflation coming down. We've heard that from Austin Goolsbee. We talked about gradual rate declines from Mary Daly over the weekend. We heard that from a whole host of others as well, including Neil Kashkari. So if he leans into that, people will say, great, I can go on vacation.
2025 is a bit of a mystery. And to fill in some of the gaps of that mystery, I think we need to talk about the politics and the policy that's going to come out of the DNC this week. We've had a vacuum when it comes to understanding what the policy platform actually is on the Democratic ticket. We've had a sprinkle of language here and there about price gouging and child tax credits and not having taxes on tips, which is something we heard from the former President Donald Trump as well. You just wonder if we get more detail this week, because I think we really are lacking real detail about what policy is going to look like in 2025. And if we're going to have a serious conversation about monetary policy for the next 18 months in Jackson Hole, Wyoming, don't we need a serious conversation about fiscal policy in Chicago?
And it's really hard to have those conversations about what 2025 will look like, what the Fed will be dealing with, depending on who is going to win the White House. When it comes to the Democratic ticket and their economic policies, we heard a little bit of that, a sprinkle of it, as you would, Jonathan. But it's really lacking in the details. details. Jason Furman saying that, at least when it comes to price gouging, he hopes the proposal ends up being a lot of rhetoric and not reality. And I think that is really the takeaway for the entire policy proposals we're going to hear at the DNC. A lot of rhetoric, likely not reality.
It's so sweet. You're saying, wouldn't it be nice if we get, more details? I hope. Don't you think that we will? The answer is, of course, we're not going to get that. But keep hoping. It's actually really endearing.
This is what makes it so difficult. Anything you hear from the Federal Reserve on Friday, you've got to at least acknowledge there's a lot of stuff they don't know about 2025 and beyond.
Which is the reason why a lot of people are just adopting, we don't know what we don't know, so we're going to go with what we do know, and we're just going to talk about the near term. And that's basically what you hear from pretty much every investor out there.
And the outcome of all of that over the last week has been buy stocks. 7 days of gains on the S&P 500. Day 8 potentially. Equity futures this morning just about positive on the S&P by almost 0.1%. In the bond market, yields lower by a basis point or two, down 2 basis points to 386.35 on a 10-year. Coming up this hour, we'll catch up with Jim Caron of Morgan Stanley, with stocks coming off the back of the best week of the year. White House senior advisor Amos Hochstein as Israel and Hamas talks come to a standstill yet again. And Lindsey Piegza of Stifel on the Fed's September tightrope. We begin with the big issue. Stocks notching their best week since October 2022 as investors digest data pointing to a still resilient US economy. Jim Caron of Morgan Stanley weighing in on recent volatility, saying this: perhaps the price action told us more about market positioning than economic fundamentals, which are cooling and normalizing, not collapsing. The speed of the market move is more significant than the magnitude. Jim joins us now for more. Jim, wonderful to catch up with you once again, sir. I want to sort of rewind just a couple of weeks because we caught up really at the height of this growth scare and this big cratering we saw in markets all over the place, all that drama, Jim. And you said buy some of that fear. You were walking into it, leaning into it and saying, buy this market here. Jim, what gave you that sign? And are you sticking with that view from here into year end?
Thanks, John, and good morning. Yeah, when we last spoke in early August, right after all of the volatility in the markets, our view was that around 5350 in the S&P 500 was roughly a fair level for markets. That basically represented $275 earnings in 2025 and about a 19.5 multiple. Nothing egregious. I think that's pretty reasonable. The overshoot that we saw did not match up or did not line up with economic fundamentals. Yes, we had a slightly softer payroll number. It created a lot of excitement. There was the unwind of a yen carry trade. All of these things happened at once. There was definitely an unwind of a lot of positions. That's what made us say, look, what matters more to markets? Is it technicals or is it fundamentals? Will the technicals trigger something fundamental? And we basically said no. And the way we thought about it was that this was a good opportunity from a value and risk balancing perspective to add to equities. And we did. We added to Japanese equities. We added to U.S. equities. And really just the beta. We just went right into the markets. And now, we might parse that a bit. But effectively, we still think that, the market is in a secular bull market. Now, I will say this also. 5350 is still my number. So the fact that we are a little above that or decently above that now is actually making us think about taking some profits on that. I think it's going to be difficult for the markets to really run much higher than around 5,600, which was close to the highs that we saw in July. So I think we've had the recovery, and now it's time to rebalance some of those risks a little bit down and maybe take some chips off the table.
Where would those chips go? And Jim, this raises a different question. You were willing to go against the grain in the equity market at the start of this month. I wonder if you're willing to go against the grain in the bond market, given the argument we heard about 20 minutes ago. And we've heard this argument repeatedly. Rate cuts are coming, add to duration, avoid reinvestment risk. Are you taking the other side of things in fixed income too?
Yes, I am. And look, effectively, I think the markets had priced in. One of the big overshoots that we saw was the market was starting to price in 200 basis points of rate cuts to 250 basis points of rate cuts. We thought that was excessive. So effectively, if we get a policy move by the end of 2025 where the Fed funds rate gets down to 4% or 3.5%, I don't think 10-year yields will be materially far away from where they are today. What we have to remember in fixed income is that there are two components of return. One is the coupon and the other is the price movement. I don't think over the next 12 to 18 months, you're going to get a lot of appreciation out of the price movement. But what rate cuts by the Fed do is they really ensure that you're likely to get the coupon. So the return expectation for fixed income should likely be the coupon at this point, not so much the price movement of the bond, which is what we refer to as the duration element of market. So I am pushing back against it because I think the bond markets actually are running well ahead of even what the Fed may say coming up to Jackson Hole.
We talk about the Fed when we talk about the belly of the curve, the 1 to 5 year kind of maturities. I am wondering how much the fiscal backdrop weighs on you when you start talking about 10-year treasuries and beyond.
Yeah, I mean, the fiscal is my number one worry. I mean, if people say what keeps you up at night, that's what it is. It doesn't matter what the next administration is or whatever. We're going to have to deal with this fiscal problem. The issue is that we have a deficit around 6% of GDP in a period of time when things are kind of going okay. Imagine if we did fall into a harder recession, and typically there needs to be fiscal expansion to support the economy. Where does that put debt to GDP? Where does that put deficit to GDP? Does it put deficit to GDP around 10%? I mean, my gosh, this becomes a bigger problem for us going forward. What it really tells us is that the safety net from the federal government to have fiscal expansion to be counter-cyclical in a period of weakness is a lot less today. That makes the U.S. economy in a more dangerous, vulnerable place because it doesn't have the ability to do counter-cyclical policy as much.
There are two different sides to this. There's one that might not be as supportive to risk because going forward, there won't be sort of the relief valve in some sort of downturn. And then on the flip side, there's this question of whether yields have to be higher and auctions messier going forward. Which is it for you? Is it really the fiscal response to some sort of downturn, or is it the fiscal overhang that causes bond vigilantes to raise from their grave and come out with sticks?
That's a good way to put it. I think it's a little bit of both. I mean, to be very honest, I think it's really the fiscal maneuvering room that we have a lot less of. I think that's much more important. The bond vigilantes will work with the markets if there's a profit to be had by being long bonds and yields going down. That'll be taken. But we have to think about the shape of the yield curve, because what we have to understand is that in this particular environment, if there is an inflationary backdrop, which I believe that there is, when the Fed cuts rates, when there is fiscal expansion, that adds an inflation impulse to the markets, which means the curve steepens. So if the old playbook was, let's cut rates and let's bring down that 10-year rate, let's bring down that 5-year rate, the answer today may be that 10-year and 5-year rate may not come down as much as it used to do when we were in a disinflationary, deflationary period. That's the risk, is that the curve steepens out a lot more, in which case the rate cuts don't bring down the borrowing costs where most people, not just banks, but most people buy cars and houses and things like that, and corporations fund themselves at, which is the 5 and the 10-year point. And that's one of the big things I don't think is really spoken about enough. And I think Powell's going to have to address this at Jackson Hole a little bit.
I just love that you answered that with a straight face. Jim, thank you. Jim Caron and Morgan Stanley.
As he should.
Why have they got sticks? That's what I want to know. Why have they got sticks?
They're protesting. It's like pitchforks. Right. They come with pitchforks. That's what bond vigilantes do.
Yeah, right. It's not okay. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Donald Trump is battling Kamala Harris for momentum this week. He's planning an aggressive schedule as the DNC kicks off in Chicago. Trump will hold rallies in 4 swing states and visit the U.S.-Mexico border on Thursday. That's ahead of Harris's acceptance speech at the DNC. He'll also sit down for a series of interviews. His aides say it's an intentional effort to goad Harris into an unscripted interview herself. A Washington Post ABC News poll released Sunday shows Trump lagging Harris by 4 points. San Francisco Fed President Mary Daly told the FT that she has more confidence that inflation is under control. Even so, though, she argued for a patient approach to policy, saying gradualism is not weak, it's not slow, it's not behind, it's just prudent. She added that the economy is not in an urgent place and that while slowing, the labor market is not weak. Her comments come ahead of Jackson Hole, where Chair Powell will speak on Friday. And Estee Lauder CEO Fabrizio Freda will retire in June of next year. The company says it is well advanced in its hunt for the replacement. Freda will remain in charge until a successor is named. Estee Lauder also reported earnings this morning. They forecasted annual growth that missed expectations. As of the Friday close, shares have fallen 35% year to date. And that's your brief, John.
Danny, thank you. Thank you very much. One further top story, the top story. Happy birthday to our good friend Mohammed Al-Arian. I won't mention the age. You can check that out on Wikipedia. I promise we stop counting at 50 until I catch up, and then we resume.
Happy birthday. I mean, honestly, what kind of national event will he be at? Will it be the Olympics this time? He was like in the front row of all the major ones. I mean, Taylor Swift. What's the next sort of...
Something like a 12-month celebration, like on repeat.
Rightly so.
Mohammed, thank you for being you. We appreciate it. Up next on the programme, the Morning Calls Plus. White House senior advisor Amos Hochstein as Israel and Hamas truce talks stall once again. That's next. You're watching Bloomberg Surveillance. Live from New York City, welcome to the programme. We're counting you down to the opening bell, about 1 hour and 14 minutes away. Your scores look like this on the S&P 500. Equity futures just about positive by 1/10%, looking to build on a 7-day winning streak on the S&P. Let's get you some morning calls. Your first one, first up from Piper Sandler, downgrading Shake Shack to neutral. The firm tempering its view on fast casual dining, adding that risk-reward for the burger chain has become more balanced. That stock is down by 3.6%. Your second call from Morgan Stanley, downgrading HP Inc. to equal weight, keeping a $37 price target. The firm saying that the personal computer company now offers limited upside on both estimates and valuation. And finally, MoffettNathanson initiating coverage on Apple with a neutral rating and $211 price target. The analyst Craig Moffett saying AI potential is already priced in, but noting that execution risks are still on the table. That stock is still just about positive by 0.6%. There's some of the morning calls. Let's turn to geopolitics. Secretary of State Antony Blinken arriving in Tel Aviv as Israel and Hamas truce talks stall yet again. Senior advisor to the president for energy and investment, Amos Hochstein, playing a key role in easing tensions in the Middle East for the Biden administration. He joins us now. Amos, great to see you. Widely regarded as one of the president's most trusted security advisors. You were in Beirut, I believe, in the last week as well. Can you set the stage for us? Just help explain to us where talks are currently, both between Lebanon and Israel, and what's happening currently in the Gaza Strip as well.
Well, first, good to be here. Thank you for having me. I was in Beirut last week. We had obviously rising tensions and escalation of different reprisals and different threats across the region. The president had ordered large parts of military, U.S. military to the region, and of course diplomacy to commence as well to be able to reduce tensions. The most important thing the president is focused on now that we want to achieve is a ceasefire agreement that brings the hostages home finally to their families, brings relief to civilians in Gaza, and sets the stage to end this war. That's the most important thing. So the talks in Doha last week, talks continue right now. As you said, Secretary Blinken is in the region, in Israel today. And I take issue with stall. I think that the press wants to have some, there's movement every single day, but these are very serious discussions that will continue over the next several days.
Well, educate us. Where has there been movement?
Well, I can't, obviously, for obvious reasons, can't go into the details of the details of the talks, but they are progressing things. That's why Secretary Blinken is there, and the work will continue. This never happens overnight, but I'm confident that we'll continue to push as hard as we all can. And when it comes to Lebanon, look, we had a ratcheting up of escalation. We're trying to bring some of that down. I was there really to talk to folks about how do we think about the day after and talk about bringing some sense of normalcy for Lebanon. Look, Lebanon is at a war that I think its people don't want, that neither side really started. Hezbollah decided to join the conflict on October 8th, and we've been in a tit for tat ever since. So it's really important. That is a critical piece not to allow to escalate as it has ramifications for the rest of the region.
Well, Amos, you spent a lot of time with Lebanon's Speaker of the Parliament, who's very close to Hezbollah. What did he tell you about Hezbollah's intentions when it comes to Israel?
Well, as you know, Hezbollah and Israel have gone on rounds of conflict over the last several decades, on every several years. We've had relative quiet since the 2006 conflict ended and through the Security Council Resolution 1701. It has never really been implemented by either side. So we need to get to another point. I think the speaker, as well as most Lebanese people, they just want this to end. They don't understand why they're at war.
But what tools does the U.S. actually have to pressure Lebanon?
Well, again, we can talk about what does it look like to end not only this round, but to put things in place that will create stability for the long term and bring economic growth and stability and prosperity in Lebanon. It's used to be one of the most successful countries today. They went into total blackout the other day because they lost the last fuel in their power plants. I mean, this is a country that should be prosperous. So that's the kind of things the United States and our allies can do. And I think the people of Lebanon want that. We have to get past this. One of the things that will make it a lot easier to do that, of course, is the ceasefire in Gaza.
Okay, so let's talk about the ceasefire in Gaza. The president said potentially this could be a way to halt Iran from retaliating. Iran has come out overnight and said that's not true, we're going to retaliate. Do you view these talks, which Secretary Blinken is talking about last-ditch final effort basically this week, as halting an Iranian retaliation, or does the administration still expect Iran to retaliate?
Well, I think the president has made clear his expectations when he gave orders for the U.S. military to take several actions to be able to defend both Israel and the region from a potential retaliation from Iran. We don't believe Iran should retaliate, period, but we want to de-escalate. And that's why the U.S. military is there. But at the same time, we are focusing on the diplomatic effort, diplomatic push, and that's why Bill Burns and Brett McGurk were in Cairo and Doha last week, why Secretary Blinken is in the region today and in meeting with Prime Minister Netanyahu just today. The United States put down a draft on Friday, so we're working with the parties to be able to get to an agreement.
Who is at fault here in terms of the gaps? Is it Hamas or is it Benjamin Netanyahu?
I'm not going to go into faults. I think there's no time to waste now, and neither party has an excuse to delay. If you want to bring some relief to the people in Gaza, if you want to bring the hostages home, this is the time to reach an agreement.
Why is this the time?
I think it's been a long time. This conflict has gone on for long enough.
I get that, but we keep hearing that now is the time. Why is now the time? What happens if Secretary Blinken comes back without an agreement?
Well, I don't think he's going there to come back with an agreement. It's just to move the process along in order to get to the point of an agreement. And I think he will do everything that he can. This is the most important moment. Talks have been intensifying. We've seen what the chances and odds are for escalation. That's not something anybody wants.
I guess another way to put this is Tony Blinken said that this may be the last chance to reach some sort of ceasefire agreement. What happens after that?
Look, I want to focus today on being able to get there. And so that that's why the president's saying that he's going to put as much of his efforts that he can in order to get to that outcome. That's what we're focused on.
Amos, how difficult is the president to put all these efforts in when he's viewed internationally as a lame duck?
I think, first of all, there's one president. He is the president of the United States. I can tell you I've been traveling the world. I don't think that is the view. Everybody knows we have an election coming up. He's the president for the next 6 months. And this is a crisis that cannot wait 6 months. I think everybody knows that. If you're talking about things that will happen over the next several years, then people will focus on talking to the next president, Kamala Harris. But I think that for now, these are not crises. When you talk about the U.S. economy, you talk about the global economy, you talk about the crisis in the Middle East, these are not things that everybody's going to say, well, let's just take a break and wait till January. That can't happen. So that's why you're covering the economy the way you are, and the president gets briefed. The last couple of weeks have seen volatility in the markets. We don't pretend that that we're just going to wait to January.
How often do you speak with the president?
As needed. Some weeks more often.
When was the last time?
Just a few days ago.
Just a few days ago. How engaged is he in these ongoing talks?
Extremely engaged. He has convened his team on a daily basis. He talks to folks to get regular updates. He is very, very engaged. He has calls with world leaders and regional leaders also weekly in order to be able to push this forward.
Your future, does it end with Biden or continue with Harris?
I served President Biden. Ask me that again in 6 months when when President Harris takes office.
We have to say if, you can say when. We'll talk again in 6 months. Before that, no doubt. It's good to see you, sir. Thank you. White House Senior Energy Advisor Amos Hochstein there. Anne-Marie, on the state of play in the Middle East.
What I found so interesting is that Amos Hochstein did basically say, when Secretary Blinken says this is the last opportunity to get a deal, he's not actually going to be coming home with a deal. So these talks will likely continue, even if there's no breakthrough within the next 24, 48 hours.
This coverage will continue as well. Coming up on this programme, we'll catch up with Lindsey Piegza of Stifel. We'll catch up with Mike Schumacher of Wells Fargo. An assessment of where we are in the US economy and what it means for monetary policy, and ultimately what it means for this bond market with Mike Schumacher of Wells Fargo. Your equity market on the S&P 500 shaping up as follows. On the S&P, just about positive by 1/10%. In the bond market, yields are lower by 2 or 3 basis points, 385.40. Music to Amos's ears. Crude is lower by 0.9%, 75.95 on WTI. And I'm sure you'd love to find time to talk to us about what's happening with the SPR, but we'll have to do that another day. Okay? From New York, this is Bloomberg. Okay, so we're about 60 minutes away from the cash open. Let's start with the scores. Equities are positive by, let's call it 0.1%. No drama at all this morning. On the Nasdaq, up by 0.1%. Also, if you turn the page, switch up the board and get into the bond market, the 2-year exactly where it was a couple of Fridays ago. So 4.04% is where we are, down about a basis point. Plenty of volatility, though, through the week, particularly towards the back end of last week when retail sales came out much better than expected and jobless claims came in lower than expected as well. The 10-year down by about 2 basis points to 385.97, and further out along the curve, a 30-year at about 4.1%. Just want to touch base with the FX market just to give you a flavour of things. The dollar weaker over the last 4 weeks. On a weekly basis, it is the longest losing weekly streak on DXY going back to April 2023, 4 weeks of it. On dollar yen right now, more dollar weakness. Yen strength, 146.18. And we've noted this observation a few times this morning, Lisa. Interesting that we've got this move in dollar yen, and what you don't see in the equity market. The equity market is not standing off in the face of this, which gives you the impression, never mind all the estimates, that maybe a lot of that work has been unwound.
So this raises this question, how much of the carry trade has been unwound? There are other people saying that the probability of, months and months of a carry trade being completely unwound in 1 week or even 1 day seems unlikely. That said, there is a peaceful feeling out there with the idea of dollar weakness. I'm looking not just at the yen, but also in terms of yen strength, but also the euro crossing squarely through 110 to the highest levels, the strongest levels going back to the end of last year. It seems like there are shifts afoot that are not being massively disruptive in the way that they were about 2 weeks ago.
You know that feeling when your European vacation is complete and you don't really care about the direction of dollar yen or euro dollar anymore? You just sort of see euro dollar through 110 and you're like, do whatever you want now. Bramo's done our trick.
Okay.
Take out 115.
Hold on.
Much better when I was there for the G7.
I will. Okay, fine.
Lisa's
I will just
kids
say,
went over to Tokyo, and now dollar yen just doesn't matter.
Nailed dollar yen.
You nailed the top of dollar yen.
They did nail the top of dollar yen. They really enjoyed sushi. They had a sushi conveyor belt that came on a bullet train. They were very happy.
Amazing.
Yeah. Okay. Let's move.
Bramo nailing dollar yen at 160. Nailing the euro at sub 110, around parity for a European trip. Everyone's going to want to know where you're going next and when. Under surveillance this morning, the DNC kicking off today with President Biden set to deliver primetime remarks. Vice presidential nominee Tim Walz delivering his formal acceptance speech on Wednesday. And on Thursday, it's the main event. Kamala Harris will formally accept the presidential nomination. Anne-Marie, you'll be there in the room. What are you looking for?
I hope so, Jonathan. That's if I can take off. I tried last night, didn't work out so well. So I think this is going to be a 2-part DNC. The first part, Biden basically flying in, flying out, but going to give this speech. And the room is going to really want to make sure he gets the proper send-off. And then it's going to shift quite quickly to this coronation of Kamala Harris. I would go to what Jason Furman said in one of the papers, which was he hopes that at least the price gouging proposal ends up being a lot of rhetoric and not reality. I think what we're going to get at the DNC is a lot of rhetoric and not a lot of reality of some of the policies we're going to hear. And then I would look at all the analysts we've had on, which basically said, enjoy your vacations, enjoy the beach, look at the polls after Labor Day.
Come back for that first debate in September. That seems to be the main event for most people.
Especially to see whether they'll actually talk about issues, whether it'll be, a trash-talking contest, whether it will be the ongoing continuation of the honeymoon period that you noted with respect to Kamala Harris.
The issues don't go away. I want to reflect on the conversation we just had with Amos Hochstein just moments ago. we've still got a sitting president that's trying to address two conflicts taking place, the tension between Israel and Lebanon to the north, and the tension between Israel and Hamas, the war that's taking place in Gaza. And the talks are ongoing. Now, look, we use the word stall. It certainly looks like talks have stalled when you have a repeated sequence of talks that ultimately continue to go nowhere. They tell you that there is progress, but won't tell you where we've made progress. You asked about sticking points. We can't talk about sticking points. You asked about what's holding us back here. It's the Israeli side or Hamas. Couldn't get into that either. I understand the nature of these conversations mean you can't share too much, but these talks have been going on for a while now, and it's very hard to point to progress anywhere.
Well, it does also, though, seem that Amos Hochstein, when asked about who's really at fault, he basically said everyone needs to get on board. So not just putting the blame on Netanyahu or Hamas. But Antony Blinken, who's in Israel, going to be meeting in Jerusalem with Benjamin Netanyahu, said that this is a last-ditch effort. They are really trying to get this done before November 5th. And you asked why now? Why now? Well, what's happening at the DNC is there's going to be thousands of protesters outside the DNC who are painting Kamala Harris as part of what they believe is failed policy in Gaza.
It's a problem for the party and for the ticket going into November. As sent to this story, Chicago Fed President Austin Goolsbee telling Face the Nation on CBS that inflation policy from Harris or Trump must be scrutinized. Goolsbee avoiding directly speaking about the presidential race, but warning against the misrepresentation of the inflationary impacts of tariffs as well as corporate price hikes. Now, the problem we've got here, Lisa, the problem for them, for all of us, is that it's very difficult to set monetary policy for 2025 and beyond when we have no idea what we have in store in 2025.
If you listen to how he answered some of Margaret Brennan's questions, it was fascinating in that so many issues that are economic in nature have been so politicized that it's hard to have an honest conversation about them that will be treated as nonpartisan. I'm talking about tariffs. I'm talking about price gouging. I'm talking about tax cuts. I'm talking about other things that are being proposed right now. And basically what Austin Goolsbee said was, all of these issues have been politicized, so I don't want to weigh in on tariffs. I don't want to weigh in on price gouging, et cetera. So this becomes a sort of difficult moment where it's unclear what the policies are. And a lot of economic analysts are looking at this and saying, I don't want to weigh in too much for fear of being viewed as political. It's a little bit fraught right now.
You can have those debates in Jackson Hole later this week.
I'm excited for that.
Now, I'm going to be very careful with language in Jackson Hole, Wyoming, because that's a place and that's where the conversation will take place. Michael McKee out on Twitter this morning. The cliche police have called, as we spend the next 4 days previewing the Federal Reserve Chair Powell's speech, avoid using the phrase all eyes on Jackson Hole. It has been classified as a writing felony. So, Mike, I'm going to do my best. The Kansas City Fed's annual Economic Symposium, is that
Correct.
right? Thank you. Okay, takes place this week, and Chairman Powell delivers a speech at it because he's been invited to it by the Kansas City Fed.
Right.
Okay, we've got that. Okay, speech takes place at 10 a.m. on Friday. What are we looking for?
Catchy.
Well, I tell you,
it doesn't work, does it?
Not in the slightest,
Thank
but
you.
good try.
you did well. I mean, I'm just glad that Wyoming is in the United States. We use the dollar because Lisa's going, and we don't want any problems there.
All right, okay.
I think that probably Wall Street's hopes are overdone in the sense, I mean, you look at Mohamed El-Erian, a good friend of this program, a good friend of all of ours, and he has this long list of things in his op-ed today that Powell should say that I don't think he's really going to get to. The main question for everybody on Wall Street is, do we get the green light for a September rate cut? And I think you get some shade of green from Powell because the data support that. But he's also going to warn we still have some data to come, so we'll watch that. And then the stuff about what is the neutral rate and where do we go, he has been asked that, Powell has, and he doesn't answer it because he said we don't know. And their plan basically is to take it meeting by meeting, and if the data still are on the same track in November, then maybe they cut again, and maybe again in December if that's the case, until they figure out where they think neutral is and we stop having some sort of restraint on the economy. The theme of the conference is the transmission of monetary policy, and has that changed? So he might preview the idea we're going to do a review of our monetary policy framework this year, but he's not going to talk about what he expects it to be because he doesn't want to front run that.
Do you think it's going to be an 8-minute pain speech? Not with pain, but with, sort of, we did it kind of speech? Or do you think it's going to be... I think it's going to be a pain speech or a painful speech. You know, you remember back a couple of years ago when he came out, there's going to be pain.
I remember that speech.
It was 8 minutes. We were like, really, that's it? That's all you're going to do? And we're sitting there, okay, wow. I'm wondering if it's going to be this sort of long, rambling discourse on, you know, whether interest rates, like once upon a time there was an interest rate, or is this going to be something that's a very direct, we have room to cut, we will cut, we'll monitor the data, see you next time?
So it's probably somewhere in between. I mean, this is getting back to the way Fed chairs usually address the conference when they're not trying to make a policy pronouncement, and he'll probably talk about some of the history behind where we are and sort of set up the academic part of the conference. It won't be a pain speech. It won't be 8 minutes long. We will have, I think, a full complement of remarks from the chair.
Mike McKay will be the grammar police for the next few weeks. Next week on Jackson Hole. Mike, thank you, sir. Michael McKee there. Lindsey Piegza of Stifel joins us now for more. Lindsey, thank you for joining us. Let's get into this. Do you think that the CPI report last week gives the Fed and the chairman just a bit more space to validate some of the market pricing going into September?
Well, I think it certainly gives the Fed more wiggle room to move forward with a potential rate cut in September. But I do think that the Fed, at least when we look out to Jackson Hole, is going to continue to reiterate the data-dependent stance. Now, the market has clearly been overreacting. We've seen the market calling for a larger 50 basis point cut next month. We've even seen calls for an emergency intra-meeting reduction. And so I think data, the strength in retail sales, the strength in jobless claims, juxtaposed with the improvement in the CPI and the PPI last month, but coupled with the volatility in market reactions, I think Chair Powell is going to keep his cards very close to the vest and reiterate that data-dependent stance, that we need to see still confirmation of this further disinflationary trend in the PCE data and further data points between now and the September FOMC meeting.
Lindsey, it's a pretty bold idea for what this Fed conference is actually going to be themed. The idea that really is the question that so many people have been asking. How effective is the transmission of monetary policy? Do you think that they are going to come out and say, given all these different demographic and economic shifts, their role in the U.S. economy is much less than it used to be?
No, I don't think he's going to come out and say that. I think he's going to say that the Fed continues to face a number of challenges. The economy is changing. We continue to face challenges as economists collecting data, making sure that we're accurately accounting for growth and inflation in the economy. So he's going to reiterate the ongoing transitions of demographics and different factors in the economy, but he's not going to downplay the very important role that the central bank and monetary policy play in shaping the business cycle and the overall growth rate in the economy. But again, when it comes to the expectations for policy, he's going to remain still very vague and talk about maybe a need to review policy, maybe needs to update policy, but reiterate the importance and the ongoing challenges that the Fed faces.
So it sounds like you're not expecting much, Lindsey. Is there anything at all that you think that we will get from this that could be market moving or frame how people look at the Fed's reaction function going forward?
Well, I think it's going to be disappointing to the market. I think the Fed chairman's comments are going to fall short of the market's expectation for a commitment to a reduction in September. And that's what we saw in the July statement. The Fed maintained the language that they're still not confident that a policy pivot is appropriate at this point. That was disappointing to investors, and I expect that we continue to see that disappointment. Now, that being said, a September rate cut is still very much a possibility and an increasingly likely possibility after last week's inflation data. But the Fed wants to see that confirmation in the PCE. If we see that, the Fed is likely to focus on that green light for September. But if we don't, again, the Fed wants to maintain that wiggle room, that movement. And so I think the Fed is going to be very clear that we're not there yet. We're almost there. We're approaching a pivot point, but they want to keep their policy close to the vest.
Appreciate the update. Lindsey, thank you. Lindsey Piegza there of Stifel going into Chairman Powell's address on Friday. For more on that address and what it means for financial markets, fixed income specifically, joining us now is Mike Schumacher of Wells Fargo. Mike, I want to go to this question first of all. Whether you still believe the big drop in yields is actually behind us and not in front of us. And if so, why is that, Mike?
We do. It's interesting, John. When you look at the market action over the last few weeks, especially early August after that really crummy jobs report, markets went bonkers, yields went down a ton. And if you look at the relationship between long-term yields and Fed funds pricing, it's been pretty much intact. And what it tells us is that we think that if yields were to drop down to, let's say, 350 and 10s, you probably need an extra 60 to 70 basis points of Fed easing priced in. That seems like way too big a hill to climb. So for the market to price 250 basis points of easing by the Fed next 12 months, I think that's far-fetched. So we do think the big rally's done.
Mike, do you believe this idea that the Fed should be easing by at least 100 basis points just to even remain neutral at a time when inflation is really decreasing at a rapid pace?
The Fed should cut pretty aggressively, I think. When you look at real yields, they're still very, very high. We've talked about that a bunch. A lot of your guests have over the last month or so. And that story hasn't really changed a lot. Powell's probably going to mention this on Friday. Goolsby's talked about it. Others have too. But taking real yields down fairly soon, we think that makes a lot of sense. And that suggests fairly aggressive cuts.
So how do you think that the rally is behind us? Do you basically think that the market's priced in the aggression that the hikes will take? I mean, that basically it won't get much more than this going forward?
That's right. So you look at market pricing today, plus or minus 185 basis points priced for the next year. That's quite a bit. I could see that getting bumped up to maybe 200 and change. But the idea of that going to 225 or 250, that seems pretty unlikely. I think we'll get zero out of Jay Powell on Friday. I think it's probably a good time to take a nap for most people. But when you think about the outlook, and a little humor here on Monday morning, we try and get it going. But still, when you think about the data outlook, let's say early next month, you've got a lot of events in a pretty tight space. Those are going to determine what the Fed does. But the idea of getting an extra even 30 to 40 basis points priced in, I think that's really a tough thing to ask for.
Mike, I'm not going this year. Lisa's got to try and promote it, and you're not helping at all. Are we putting that in the promo?
Yeah, please, because, I'll just go canoeing. Love it. It's beautiful there. Mike, you can come with me.
You did that before, didn't you? I remember that a couple of years ago.
Yeah. I've gone canoeing. I've gone kayaking. You can't really hike by yourself. You have to get somebody who's a willing companion. Because of the bears.
Yep.
This year, I know the bears scared you away. You're like, I'm not going to be.
Bears did scare me away.
You're just a little nervous.
You should be frightened of the bears, Lisa. That's probably the sensible approach to go about life.
We have simpatico.
Yeah, okay. Mike, I want to finish up on this. I want to change the story away from Chairman Powell and his address in Jackson Hole, Wyoming, and towards what's going to take place before that, the DNC in Chicago. Mike, how are you thinking about political considerations? And if I was to ask you who the inflationary candidate is actually going to be, can you point to one versus the other at this point?
Oh boy, that's a tough call. So when you think about the idea of inflation, I'd say for us, John, it still boils down to, do you get a sweep? So what's the chance Republican sweep versus Democrats? Probably more likely on the Republican side, given the way the Senate map works. So that would tell me that Donald Trump's probably the more inflationary candidate. As far as price controls, Kamala Harris's proposal, we could talk about that all day long. I think it's a bad idea, but still, it really lends toward Trump being more inflationary, but it's more the Senate going with him, less than Trump versus Harris per se.
Mike, how much credence do you give some of these policy proposals, which many push back and say, well, it's just rhetoric right now to get the base excited and get voters out on November 5th?
Yeah, it's pretty tough to get really ramped up about it, and I think that's why a lot of analysts and economists and people like ourselves talk about various scenarios but don't have a base case because you simply don't know how the electoral map's going to work out. And most importantly in the U.S., do you get a sweep or not? And those are fundamental questions. And for us, that's been the main issue regarding this election for a long time. So I'd say at this point, it's a lot of, they're interesting talking points, but we don't really get too hung up on them right now.
Sounds like everyone should go on vacation, Mike. Thank you, sir. Michael Schumacher of Wells Fargo, sleep in on Friday, skip the speech. Don't bother with the DNC. Is that the message here?
And by the way, we'll be broadcasting live from Jackson Hole. So if you want to take a nap, but you want some background music, just turn it on.
Solid promo there from Mike Schumacher. You've got to use that sound now.
I think we're going to.
Absolutely. Got to be honest with you.
Want to go hiking with me?
Sure.
We can scare off the bears.
I don't worry about the bears.
TK can scare off the bears. What's the line? You've just got to be, don't be the slowest. Right, you just don't be the slowest.
Or you just have to,
I just have to run faster than you.
Yes, that's
all right.
I always felt more comfortable around Tom. He just, guaranteed that you wouldn't be the slowest.
Love the way you think.
Let's
John.
get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ernesto has re-strengthened into a Category 1 hurricane. The storm is now passing near Canada and impacting the U.S. East Coast and Canadian Atlantic coast. The National Hurricane Center said life-threatening surf and rip current conditions are likely. Ernesto is expected to weaken tomorrow. The ports of LA and Long Beach, which account for nearly a third of all U.S. container imports, are seeing a frenzy of volume. It's rivaling the highest import levels set during the pandemic. The volumes do stand in contrast to concerns over a cooling economy. Instead, though, retailers are stocking up ahead of U.S. tariffs on Chinese goods and a possible strike by American dock workers. Though there is a threat that consumer spending weakens meaningfully, leaving warehouses full and companies with too high inventories. AMD has agreed to buy ZT Systems for almost $5 billion. The deal gives AMD data center technology. It's a direct challenge to NVIDIA's AI dominance. ZT makes server computers for owners of large data centers. It's the kind of customer that's been pouring billions into new AI capabilities. NVIDIA is still by far the chip industry's leader in the AI boom, but AMD is seen as its closest rival and has been making inroads. And that's your brief, John.
Danny, thanks for that. Appreciate it. And thanks for this morning. Up next on the programme, setting you up for the week ahead. And we'll head over to the DNC. You're watching Bloomberg Surveillance. 38 minutes away from the opening bell. Equities positive by 0.1%. Here's the calendar, the training diary, the lineup as follows. Tuesday, we'll get results from Lowe's and Toll Brothers. Wednesday, we'll get Target, Macy's and TJX earnings before the opening bell. Later on that afternoon, 2 p.m, we'll get Fed minutes. Thursday, the Jackson Hole Economic Symposium begins. And on Friday, Fed Chair Jay Powell delivers his remarks. Turning to the other event this week, the Democratic National Convention kicking off in Chicago today. Here's your lineup for that, with President Biden set to deliver primetime remarks. Tuesday, it's former President Barack Obama's turn, followed by Minnesota Governor Tim Walz on Wednesday. And finally on Thursday, Vice President Kamala Harris scheduled to deliver her acceptance speech. Bloomberg's Katie Lyons joins us now from Chicago at the DNC. Katie, let's get into it. Walk us through not just the schedule, but what you and the team will be focused on in the week and days ahead.
Well, of course, John, it's all going to be about energy here, considering energy to this point is what really has defined Kamala Harris's still very young candidacy. Remember, it was really just roughly 4 weeks ago after Biden dropped out that she became the presumptive and now already is, because of a virtual roll call, the official Democratic nominee. So this week very much is going to be essentially a coronation. The nomination already is locked up. So it will be a week of celebration, but specifically starting tonight, it's also going to be a week of reflection, not on Kamala Harris, but on President Biden. He is slated to speak this evening, introduced by his wife, the First Lady, Jill Biden, in what in many ways will be kind of a swan song, where, yes, he's probably going to talk about his own legacy, but also be trying to make the case for the path forward, which now includes his Vice President Kamala Harris, who everyone gathered here in Chicago wants to see win the election in November. Now, something else we're watching for here in Chicago, of course, in addition to the actual slated programming and the events that everyone wants to happen, is something that a lot of organizers probably are not as excited to see happening, which is protests over the war in Gaza and the conduct of Israel during that war. There were already some protests here in Chicago yesterday when I came in, made traffic a little bit difficult. There could potentially be more disruptive protests as the week goes on. And we've already seen some protesters showing up at Kamala Harris events on the campaign trail. She's handled them in many different ways. At one point, she told protesters she was speaking. At other times, she has used that as an opportunity to call for a ceasefire in Gaza. So the way in which the protests will be disruptive, considering this is a convention in Chicago, we saw another one like that in 1968 that was also marked by protests. That is going to be creating a contrast what's happening inside the United Center when Democrats are excited and enthusiastic about their candidate and, of course, the vice presidential nominee as well, Tim Walz. But on the outside, we could see a little bit more tension.
Kaylee, given those are going to be the pictures coming out of the DNC, besides all the happy talk inside the United Center, how unified is this Democratic Party?
Well, frankly, the party itself is pretty unified right now, at least when you think of the party elite and leadership, the very ones that essentially were incremental or influential in forcing Joe Biden out of the race in the first place. By and large, you do see the political glitterati, the chattering class, aligned behind the Harris-Walz campaign. That said, there are fractures evident in the Democratic Party based on the fact that there are uncommitted delegates who are on their way to this convention because of the protest vote over against Joe Biden in the Democratic primary process, which of course he won before stepping down. So there are divisions over that issue, but by and large, this is a party that has been very much energized by their new candidate, and that's showing up in polls as well. We got a slew of polls over the weekend, an ABC, Washington Post Ipsos poll that shows Harris nationally leading by about 5 points. There's been some other positive swing state polls as well from the New York Times, Siena. So all of that giving them energy heading into this week's events.
Hey, Kelly, thanks for jumping on with us this morning. Looking forward to your coverage, and hopefully we get Anne-Marie on a plane and she can be alongside you over the next couple of days. Coming up tomorrow, Sunrun CEO Mary Powell, Bob Michael of JPMorgan Asset Management, Gillette Lowe of Strategas, and Neil Dutta of Renmac. All in that and a whole lot more from New York City. This is Bloomberg.
The women's finals set at the Cincinnati Open. Aryna Sabalenka took out world number 1 Iga Swiatek in straight sets to punch her ticket to her first ever final in the Queen City. She'll face Jessica Pegula for the title after she came through her rain-delayed semi against Paula Badosa. The American will be looking for her second straight title on tour after successfully defending her crown in Canada last week.